payrolls we think are weak, and we think the risk is on the downside.
Our own forecast has the labor market looking quite resilient in 2026.
The Fed's mandate is not what headline GDP is doing. The Fed's mandate is the labor market.
If the labor market is clearly weak, the Fed's cutting a lot more than what's priced in.
The Fed is not going to solve the labor market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome to Bloomberg Surveillance on Jobs Tuesday. It doesn't really sound right. Stocks struggling to hold on to gains with traders focused squarely on that data. Questions swirling about the strength of the economy as we await the November payrolls report and retail sales from October, which maybe doesn't matter at all. Optimism still abounding, with investors surveyed by Bank of America looking for brighter times in 2026. Damian Sassower, I'm so glad to say, is going to be joining me for the next 3 hours. Damian, it seems like there's this dissonance between the optimism in surveys and a lack of real enthusiasm, at least in market pricing.
I think you're right. Economic expectations are finally catching up to the market. And look, recession risk is non-existent. Pro-cyclical positioning in equities and commodities is certainly on the rise.
Yeah, and this is a reason why people are looking at what could be the next catalyst. I was really struck by Bank of America's fund manager survey, the fact that cash allocations fell to the lowest level on record. At the same time that everyone seems to think that things are going to be rosy and golden in 2026, yet we're still seeing some sort of dip in markets right now.
Yeah, but I think the tail risk measures tell a lot, right? Private credit and AI tech bubble. I mean, those are some of the tail risks that investors are sort of trying to position against, and it'll be interesting to see how investors kind of do that in the year ahead. I think there's a lot of different ways, a lot of different mechanisms they can do to take advantage of where we are in the markets.
Well, right now people are in a show me kind of story, and what you are seeing is a failure for the Santa Claus rally that everyone's been hoping for. After yesterday really falling into the close, we're seeing a continuation of that sort of negative sentiment, down 0.2% on S&P futures. That dollar weakness continuing. Watch for the 118 mark on euro-dollar cross, and yields continuing to eke higher. 10-year yields close to that 4.18% ahead of that jobs report. Watch the unemployment rate. Crude falling to the lowest this year as people look to Ukraine and any kind of potential resolution there. Coming up this hour, don't miss this, Paul Quinsee of JPMorgan Asset Management with stocks on track for a third day of losses. Elyas Galou of Bank of America, as we were talking about with that investor sentiment at its most bullish in more than 3 years, and Stephanie Roth of Wolfe Research counting down to that payrolls report. We begin this hour with stocks just edging lower as markets await the latest jobs print. Paul Quinsee, global head of equities at JPMorgan Asset Management, writing, many of our investors have become somewhat more cautious. We suggest diversifying from recent winners and focusing strongly on quality stocks, especially in the small cap space. Paul joins us now. Paul, a lot of mixed messages this morning. Can you square the idea that people are feeling cautious, at least right now, but very optimistic into 2026?
Yeah, I think so. The surveys are interesting. To me, the real survey starts at 9:30 every morning, right? We can look at the market and see what that really expresses what investors are thinking. Investors are feeling pretty good right now. So the earnings growth has been terrific, and I think everyone, including us, expects that to continue into next year. But it has not gone unnoticed. So this year has been, again, triumph for the optimists in terms of the fundamentals. Think how different things feel now to April. But when you look at how that's expressed in market pricing, it's the triumph of the very optimistic. So we've got an S&P 500 trading at 23 times next year's solid-looking earnings numbers. That's one of the highest levels we've seen, as we all know. You've really got to go back to 2000 to find a much higher multiple. And then within the market, you've seen this tremendous appetite for some of the most risky, most aggressive stocks, particularly, in the small cap space. So investors are feeling pretty good about just about everything.
So this raises this question. How can you be so optimistic if you've got cash levels falling to the lowest levels in the history of the Bank of America Fund Manager Survey? I realize you're global head of equities for JPMorgan Asset Management. I'm not going to ask you to talk about, the sharks and the jets, but I am curious about how much that's a contrarian signal to you at a time when there still are a number of concerns out there.
Yeah. So as always, in the end, the fundamentals will dominate, right? The fundamentals will drive stocks. As we look into next year, we see pretty good earnings growth in the US. We see pretty good earnings growth in other places as well. So emerging markets, for example, where we have not seen, at least until recently, anything like this kind of level of excitement. The 15-year return on emerging markets is a miserable 5% a year. So it's been a long time kind of in the shadows. But this year, they're up a lot. And that's for good reason. Earnings in emerging markets growing 15, 16% this year. We're pretty confident that continues into next year, too. So there are places where you can invest into strong earnings growth and not have to pay record valuations and buying everything at record highs.
Yeah, but Paul, emerging markets, they don't have nearly as much liquidity. It's a much smaller market. Just how much of the $17 trillion that foreign investors have currently parked in the U.S. equity market, just how much of that $17 trillion can be shifted into emerging market, or for that matter, international equities?
Yeah. So, well, if you get there first, then you'll benefit from that money moving, right? I mean, I think certainly as we look at how investors around the world are positioned, they are more concentrated than ever in large cap U.S. stocks. That's been the place to be, right? And the large cap U.S. index makes up 2/3 of the world's total market capitalization. If you go back 20 years, it was roughly half that number. So you've had this tremendous concentration in the U.S. And look, it's happened for the right reasons. It's been driven by better earnings growth. America, on average, has the best companies and the best industries, and it's attracted a tremendous amount of capital. But it's also now comes with high valuations. And again, when you look forward at where returns are going to come from, I'm not so sure you want to be looking just at where they've come from in the last 10 years.
Well, Paul, back in late October, you and your colleague, Anuj Arora, I believe, talked about the 50% valuation gap between Asian tech stocks and those here in the U.S. That hasn't really gone away just yet. Are you still professing that Asian tech stocks, the AI play, has legs to it?
Yeah, no, I think that's definitely part of the attraction of emerging markets. You can buy technology at much lower prices. And these are great companies, too. These are central to the whole AI story. Their businesses are booming, and yet you're not paying anything like the kind of valuations you have to in the US. When you look at emerging markets overall, about 20% of the earnings come from tech. And they're driving about half the growth this year, and we think that continues into next year, too. But there's also a lot of other things going on. So it's not just a tech story.
So how much does the U.S. data matter, given the fact that we haven't gotten it? We're about to get it. It's going to be messy. We're not even sure what to do with it. We're not even sure how to read it. People are worried that there's going to be an unemployment rate of 4.5%. That might be okay. How are you sort of using this to factor into how to be aggressive and how to be active next year?
Yeah, so the data we're most focused on, as always, is the earnings. Of course, we get those on a regular basis. We're about to get a whole bunch more of them. And they've just been so reassuring all through the year.
But hold on a second, and I'm sorry to stop you, but there is a sort of K-shaped economy that people talk about, and there sort of is a sense that these earnings can't continue unless you get ongoing participation from a broader economic groundswell up. So at what point are you looking for that to really justify this sense that the Fed will be cutting, you'll get fiscal stimulus, and you'll get an economy that doesn't fall off a cliff that can support those earnings that are the ultimate data that you're watching?
No, we certainly want to see earnings growth broadening out in the stock market, right? We know we've been very, very reliant on a handful of companies, the greatest companies the world has ever seen in terms of their profitability, but there's only so much you can expect from that. So when we think about next year, we're looking for most of the extra earnings we see in the S&P 500 to come from the 493. So we think earnings will be up around $40 next year, and about $25, $26 of that increase has to come from that 493. All the other companies in corporate America. But we're seeing that, right? And we're seeing our earnings number. When you look at forecasts, it's not just about where the forecast is now, it's about where the forecast is going. And we're seeing those numbers edging up across a whole wide range of companies. And you're starting to see that in the market too, right? It isn't just about AI and tech so far in the fourth quarter.
Well, I mean, you talk about the earnings growth kind of, spreading into other sectors called healthcare, energy, financials. I know you like those three, but let's talk about by market caps, small caps. When I think of small caps, the Russell 2000, I think of Bitcoin mining and quantum computing. I mean, some of these companies represent roughly 10% of the index, drone flying, taxi companies. When are those companies going to generate some positive earnings growth?
Well, if you thought about those companies this year, you'd made a lot of money because we call them the memes and the themes, right? Those stocks are 10% now of the market, as you point out. They've more than doubled this year on average. Some of them are up 3, 4, 5 times. That's a very tough place to invest. And when I talk about the triumph of the optimists and the very optimistic, that's perhaps the place where you see the greatest amount of optimism. Typically, we're focused on long-term fundamentals, long-term cash flow generation. In the end, we think that's what drives stock prices. So if those companies can deliver great revenues and cash flows, then they'll be great investments. We think many of them are going to really struggle to do that, and that's one of the places where we would worry most about the kind of investor over-optimism that you referred to and that showed up in some of these surveys.
Well, Paul, I mean, I know it's the dead of winter, December, so sorry to steal a baseball analogy here, but where are we? What inning are we in the earnings cycle?
We're watching it carefully, but it still feels to us like things, if anything, are getting better, not worse. So just because things are good now doesn't mean they're going to stay good, but the momentum going into next year looks pretty good. And you sort of outlined the backdrop. We've got an accommodative Fed. We've got a tremendous amount of fiscal spending, and that extends as far as the eye can see. We've got an AI-driven investment boom. These are pretty good times. So you've always got to be worried, always got to be watching, but the data points that we're looking at and the earnings that we're seeing from companies, if anything, they're getting a little bit better.
Paul Quinsee of JPMorgan Asset Management, you'll be sticking with us. And Damien, good try. I think that was an incredible punt away from the baseball analogy of which inning. It's just getting better. So maybe the first inning.
Yeah, I mean, look, we need some bears in the room here. I mean, this is just way too bullish for me on a sleepy Tuesday morning ahead of payrolls. But I mean, look, your guess is anyone's. I mean, we do have payrolls coming up, but it's just going to be so noisy. I mean, it looks like the markets have already looked past it.
Well, I just wonder how much this is predicated on the idea of both fiscal and monetary stimulus. Yeah. This Goldilocks backdrop that people see, and how much that needs to persist. In other words, are we in for potentially some sort of offsides move in response to this jobs report that might mean nothing? People don't know how to read it, and that's why I think people are really watching it to understand how much people are waiting for the Fed to have to participate in this ongoing sentiment shift.
Yeah, well, I mean, this spread out to international equities, to emerging market equities, to unloved sectors, well, not less loved sectors, anything other than IT, right? I'm talking healthcare, energy, and financials. I mean, those are themes that we have yet to really see take hold. It'll be interesting to see if there's any longevity there.
Yeah, right now, people don't know exactly what to do with all of this, especially because we have seen a real kind of hiccup in the AI story. Right now, let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahaira on ND. Yahaira.
Good morning, Lisa. Australian authorities say Islamic State flags and explosives were found in a vehicle registered to one of the gunmen that attacked a Bondi Beach Hanukkah celebration. At least 15 people were killed in the terror attack on Sunday, allegedly carried out by a father and son. The Sydney Opera House was illuminated with a giant image of a Hanukkah menorah, as you can see there, on Monday night as thousands gathered to mourn the victims. Meanwhile, President Donald Trump filed a defamation suit against the BBC over an edit of his January 6, 2021 speech in a Panorama documentary. The edit gave the impression he had made a direct call for violence in a speech leading up to the attack on the Capitol. Trump is requesting $10 billion in damages, according to court documents filed in Florida. And NASDAQ is looking to extend its trading hours. The exchange wants to increase its hours from 16 to 23 per day. In a filing, the firm asked the SEC for permission to add the additional trading session. If approved, the change would take effect in the second half of 2026. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Is it a good idea to extend it, to make it so that you can never leave? So you always have to be in the office? You always have to be trading?
Well, Lisa, I haven't slept since 1987, so it really doesn't matter for me. But all my friends who do actually get a decent night's sleep, I'm talking 5 to 6 hours, yeah, it probably does matter quite a bit to them if they want to see their families again.
I think that everybody's going to be watching this to see how you perform on No Sleep Since 1986. Up next, ending the war in Ukraine.
I think we're closer now, and they will tell you that they're closer now. We had numerous conversations with President Putin of Russia, and I think we're closer now than we have been ever.
Bloomberg's Tyler Kendall and Oliver Cook join us for group coverage coming up next from New York City. This is Bloomberg Surveillance. Rotation underway as we end the year. This really has been the story. Even though you see that soggy headline figure in equities, you do see the equal weight S&P continuing to outperform and actually eke out gains. Right now, what you see across the board, yes, about a 30% decline in both the S&P and Russell 2000 futures. NASDAQ doing a little bit worse. But if in the equal weight, it has been a lot more stable, which raises this question: how much can you see a broadening out without the participation of the U.S. economic data? Flip up the board, 210s and 30s. You get the sense that people are concerned that there won't be enough weakness to cause the Fed to cut rates, but just enough weakness to maybe keep things on some sort of tilt. Right now, you're seeing just barely moving, but 350 on the 2-year. That long end of the curve all rising up to 4.85% on the 30-year. Damien, to me, this is really the question. Why this yield curve steepening if you think that truly this is the right move to be cutting more aggressively here?
Well, I mean, shouldn't that be good for financials, for banks, right? A steeper curve, higher net interest margins. But, you're right to point out that, industrials, utilities, these boring, stodgy sectors, companies like GE, Caterpillar are up big this year. So, I do think we've already seen a bit of that rotation out of tech and into the broader S&P. But again, just how much further can this go?
You have an Oura ring, and you haven't slept since 1986. Is it screaming at you?
Well, my wife wants to grade my sleep now. I got a 46 last night, which is beautiful. Beautiful for me.
Great, good to know. Duly noted. Meanwhile, our focus very much international as we try to gauge the latest in Europe under surveillance this morning, ending the war in Ukraine.
I think we're closer now, and they will tell you that they're closer now. We had numerous conversations with President Putin of Russia, and I think we're closer now than we have been ever. We're having tremendous support from European leaders. They want to get it ended also. And at this moment, Russia wants to get it ended.
Here's the latest. Ukraine's President Volodymyr Zelensky saying he's secured a deal with the United States to make security guarantees legally binding. Talks toward ending the war between Russia and Ukraine are expected to continue today. Our team coverage starts right now with Bloomberg's Tyler Kendall in Washington and Oliver Crook in Brussels. Tyler, I want to get your sense. We've heard a shift in tone from President Trump. He's talked before about how there's been progress made. Why is this time different and reading differently internationally?
Yeah, hey, Lisa, good morning. Well, we should say that a U.S. official did tell reporters that the security guarantees on the table would be Article 5 like in reference to NATO's mutual defense clause. And that is really what is making this different this time around, because though it is short on the exact specifics and details, this is the type of security guarantee that Ukraine has long asked the U.S. for and has long said it would be difficult to reach any sort of deal without that type of firmer commitment. Because as you're referencing here, we've really seen this ebb and flow with the administration. Just for context, the U.S. had for months suggested that any sort of guarantees would be implicit because the U.S. would have this vested economic interest in in Ukraine. We then saw that sort of shift to signal that the U.S. could provide intelligence or air cover. So the fact that this is on the table now really marks the strongest pledge that we've seen from the U.S. so far. As you mentioned, it's going to be really important that Zelensky says that he has these assurances that this could be codified and made legally bounding by Congress, because that signals that this could endure past the Trump presidency. Now, at the end of the day, we have to keep in mind U.S. officials are telling us that these guarantees are only on the table for so long as the White House is really trying to mount that pressure to get a deal done. The thing is, there's still big questions here, including will the Kremlin really come to the negotiating table on this? And we know that territory remains one of those huge sticking points, as President Trump yesterday did suggest that Ukraine should indeed cede land. Lisa, at this point, we are seeing these talks ramp up. The U.S. re-engage. This latest round of diplomacy was led by Special Envoy Steve Witkoff, as well as the president's son-in-law, Jared Kushner. Our understanding is the U.S. is going to next engage with Russia on what the potential next steps could look like.
Yeah, Ali, this really is the question, and Tyler kept referencing it, and you heard that skepticism in President Trump's commentary. At this moment, Russia wants to get it ended. What are the concessions being made on the Ukrainian side, and how feasible does the whole deal that is currently emerging seem to European allies of Ukraine?
Well, the European allies have been much more positive, and in fact, they gave a pretty detailed readout of some of the other aspects of the 20-point plan from yesterday's meeting, which also included things like keeping the Ukrainian military up to 800,000 troops. You'll remember that first 28-point plan had asked for a reduction of the Ukrainian army down to 600,000, but also going into more detail of what those security guarantees could actually compose of. They could be a coalition of the willing, which we're talking about foreign troops potentially being within the Ukrainian borders, talking about maybe seizing some of those Russian assets, bringing forward those recovery funds to try to reconstruct Ukraine. Another thing that the Europeans are bringing to the table is this potentially accelerated path for the Ukrainians to join the European Union. So trying to get their foot in the door and trying to get their sort of voices heard at the table, which they seem to have succeeded in a little bit. But as you were saying here, the sort of Europeans being very positive about this deal and the Ukrainians being very positive at this deal, I think suggests, how is Russia going to feel? The more positive these two sides are going to be, presumably the more negative Russia is going to be. And there's still that key issue of territorial concessions. The Ukrainians have softened a little bit on that. We heard from Zelensky saying there could be a referendum in Ukraine about surrendering those parts of the Donbass, or maybe finding another sort of bridging concept by the United States. But the Russians have said pretty explicitly from the beginning that there is no peace agreement. There's not even a ceasefire agreement until there is an agreement to get the rest of the Donbass under Russian control in some way or another. And that still has not been settled as of today.
Oliver Crook, Tyler Kendall, both of you, thank you so much for the comprehensive look at what's going on. Paul Quinsee, Global Head of Equities at JPMorgan Asset Management, still with us. And Paul, how much does this ongoing negotiation affect your view on Europe right now, based on the idea that a rebuild effort could be really positive, an ongoing war really negative?
Yeah, so it's all part of the mosaic for European equities. Obviously, it means a lot to the world and everyone wants to see peace. In terms of the markets themselves, it's probably not the major driving factor. We do think, though, that German fiscal spending next year really starts to kick in, and that probably happens whether or not the peace talks are successful. And that's going to be one of the drivers that we think leads to a better year for European corporates. They need it. The perennial problem in Europe, of course, is earnings growth. The main reason why European equities have lagged for so long is that the earnings have not been as good. And this year really wasn't that much of an exception. The markets have done quite well, but earnings this year in Europe are kind of roughly flat, up a little bit. So again, kind of lagging behind what we see in the US and Asia. So if the recovery in Europe is going to continue in terms of the market, we do need earnings growth to come through. We think it will, but we've got to watch that pretty carefully.
Yeah, Paul, no, I take your point. I just don't know how likely it is Ukraine's going to cede land in the south and the east that Russia has failed to occupy for more than a decade, right? We'll see how that works out. But to your point on geopolitical risk and the fact that the markets have completely ignored it for the better part of not just the last year, but the last 3 to 5. Talk to us about how you as an investor position defensively for some of these potential VAR shocks that may very well occur in 2026.
So, as a rule, geopolitical risk tends to get kind of over-focused on, I think, in markets, and it's hard to find examples in which geopolitics have had a sort of really lasting impact on investor returns. There have been a few. So obviously, the war in the 70s and the oil price crisis that followed that was a real economic event and a market event, not just a political event. And then if you had invested in Russia, then the invasion of Ukraine also was a big deal. You were essentially, wiped out overnight. A medium-sized market effectively disappeared. But those are the exceptions. And typically, geopolitics attracts a lot of attention in markets for a few days, and then investors go back to worrying about the fundamentals that tend to drive things. So that's how we try to see it. It's not to dismiss geopolitics as a real event, but in general, those things tend to get overplayed.
Paul, you mentioned tech is expensive and that you're kind of pseudo-recommending a sort of value-oriented shift into healthcare, financials, and energy. I wonder if you could expand a little bit about the commodity complex, basic materials, mining. Talk to us a little bit about this pro-cyclical shift and whether or not it can really extend into some of these Newmont, some of these names that have really, only this year begun to wake up to the reality that, there might be some demand for their product.
Yeah, absolutely. Look, I think the big picture for us is you want to be looking for good opportunities across all the markets and not just get attracted to the bright, shiny thing that everyone wants to talk about all day, but may not give you the best future returns. We had a great example of that recently, by the way. So a lot of people put out pieces on, what's happened since ChatGPT. You made 10 times your money in NVIDIA and stuff like that. But if you look at the other end of the list, over that time period, you've lost 80 or 90% of your money in the COVID stocks. They were once the bright, shiny thing. And of course, the fundamentals didn't follow through. Attention moved elsewhere. So that's just a reminder to always be looking forward, thinking about fundamentals. And as you do that, we think you see there's lots of opportunities still in tech, of course, but it's not the only thing. And we can find great companies at reasonable prices in lots of different parts of the market. Specifically in commodities, yes, you've got the demand dynamics. One of the sort of longer term positives there too is that commodity companies, including many in the energy sector too, have in recent years been paying much more attention to their shareholders and perhaps been less focused on kind of aggressive capex and expansion at all costs. So buybacks, dividends, better balance sheets, all of those give you a much sounder basis to make an investment in those companies. And when the macro does come in your favor, then of course you make a lot more money and you've got more chance of keeping it as well.
Paul Quinsee of JPMorgan Asset Management, thank you so much for being with us this morning. Happy holidays. Have a great break. Really interesting. The commodity is definitely going to get a boost. Shiny new thing.
Yeah, no, all that glitters is gold.
Yeah, evidently. Coming up, we're going to be talking about Elyas Galou of Bank of America with investor sentiment at its highest level in over 4 years. Plus, Yahira Anand with your morning movers. This is Bloomberg Surveillance. Seeing a bit of of softness ahead of the open, ahead of that key economic data that we've had to wait quite a bit for. We were supposed to get this before the previous Fed meeting last week. Instead, it is Jobs Tuesday. We do have right now a little bit of a soggy feel ahead of the open, down 0.2% on S&P futures. That dollar weakness continuing with euro at 117.55. Yields just slightly higher, although really not much action in the yield space. A real question about if you do get some sort of dovish tilt on the heels of this jobs report from the Fed. Is that going to be good or bad for long-term bond yields, Damien?
Well, I think you're talking about global central bank activity and whether or not all central banks follow the Fed. And really, the answer is no this time around. I mean, we still see a number of central banks cutting rates. We're going to see another 5 this week, like Chile, Mexico. I mean, the UK is going to be cutting rates. But, you know, a lot of central banks that have been actively easing policy are now on hold, and they're kind of shifting to more of a hawkish bias. That's very different than what we're seeing here in the U.S.
Yeah, and part of this is because what in the U.S. we're fueled also by the idea of oil prices coming down, which we see today with oil prices coming to the lowest levels going back to May. 3 hours away from the cash open, here are your morning movers with Yahaira on NT. Yahaira.
Hi, Lisa. We have some sell-side action moving stocks this morning. We start with Roku. Shares are up 4.6% on a double upgrade by analysts over at Morgan Stanley from underweight to overweight and setting the price target at $135. And the call is all about advertising. They're saying that 2026 will be a strong year for ads in the U.S. and that connected TV stands to benefit the most. Meanwhile, moving on to Southwest, the airline shares are up 2.5%. Barclays raising the stock to overweight and setting a price target of $56. The upgrade follows comments from the CEO just last week talking about Southwest pursuing airport lounges, echoing what JetBlue is doing with their first ever lounge. So this just showing us how these more economic carriers continue to double down on the premium travel. And we end on B. Riley Financial. The stock is soaring 26% in the pre-market after it filed a long overdue earnings report in an important step that will keep the stock from getting delisted from the NASDAQ. The filing follows months of pressure tied to soured investments and flaws in its financial reporting, but it's not in the clear just yet with another looming deadline in January. Lisa.
Thank you so much, Yahaira. On our radar this morning, President Donald Trump signaling the end of the war in Ukraine is closer than ever after negotiators offered Kyiv significant security guarantees that will be legally binding once voted on by Congress. Meanwhile, over in the auto space, Ford taking a $19.5 billion charge as they pivot away from electric trucks to focus on gas and hybrid models. This comes as the European Union is softening emissions rules, scrapping an effective ban on combustion engines. And it kind of goes to this question, Damien, how much is this because the subsidies were withdrawn from the United States? How much is this because the mood has shifted and it shifted away from EVs and back to the combustion engine?
Well, Ford 5-year CDS is down just 30 bips from its mid-October peak. And look, the reality is, this should get its EV operations profitable by 2029. So I guess from a operator standpoint, it is a good thing. But canceling its electric F-Series, I mean, I'm heartbroken about that. I was really looking forward to getting in one of those at some point in my life. But it looks like I'm not going to make it.
It seems like it wasn't going to be profitable, and it certainly wasn't going to be without the subsidies. And it definitely speaks to what is the future for some of these more renewable energies at a time when some of the previous investments really just are not affordable anymore.
And the EU is abandoning its emissions ban, right, for new cars, right? I mean, so it's softening the rules, right? So yeah, I mean, look, it looks like all clean energy things are going in a different direction, at least today.
Yeah. Meanwhile, on the smartphone side of things, global smartphone shipments expected to take a major hit next year. According to Counterpoint Research, output could decline by over 2% as a shortage of memory chips is expected to drive costs higher. So pause. Because of AI and the build out, all the chips are going to data centers. They are prioritizing that type of technological advancement over what you have in your pocket every single day. I just wonder how much this is going to increase costs and how much this really speaks to a mismatch in demand and supply when it comes to some of the new technology.
Well, I mean, I don't think that the overall rise in the cost of components is really going to impact the majors like Apple and Samsung. But, these smaller phone makers, some like Chinese phone makers, for example, like Honor Device and Oppo are certainly at risk here if they can't get their hands on chips and the components they need to to increase their revenue.
Meanwhile, people are still all optimistic. Turning to markets, Bank of America releasing its December Global Fund Manager Survey, showing macro optimism at its highest going back to 2021. Joining us now is Elyas Galou of Bank of America. Elyas, great to see you. Thank you so much for being with us. Let's start on the cash holdings. The idea that cash allocations fell to 3.3%, the lowest in Bank of America's Global Fund Manager Survey. How much of a contrarian indicator do you see this as?
This is a very contrarian indicator, Lisa. Look, I mean, just a bit of context on the FMS cash levels, which fell to a record low 3.3% today. This series is one of the most important of the Fund Manager Survey. It has been around since 1999, so we are able to track several cycles through this series, and even at the height of the internet bubble, at the height of the subprime bubble, and during the bond bubble of the post-GFC era, the FMS cash level did not drop to the level it did today, 3.3%, which is just strictly speaking and focusing on this metric, this is a very bearish contrarian signal. And we backtested this series since over the past 25 years, whenever the cash level fell to 3.6% or below, the average 4-week return for global equities has been minus 2%. And over 8 weeks, it's been global equities were flat.
Elyas, how do you square with this with the idea that people are really optimistic about 2026 returns? Is it consistent, given the fact that we might see sort of meandering stock returns heading into year end, kind of what we're seeing this morning? But next year, people will see that fiscal stimulus come in, that monetary stimulus come in, and it will really support this sort of broader story that people seem to be leaning into.
I think if we had to define the December 2025 Fund Manager Survey, it would be the most bullish survey of this AI-led bull market. And the culprit of this palpable bullishness is the expectation of run-it-hot policies. FMS investors look at the Fed, they know and are convinced that the Fed under the next chairman will be much more accommodative than in the past few years. They know that there is a big election in the US on November the 3rd next year, and they expect the administration to push a bit further in terms of fiscal policy. And they also know last week's announcement from the Fed in terms of the liquidity backstop, I think has clearly emboldened FMS investors to increase allocation to risk assets. Because another important metric that was extreme in this survey was the fact that liquidity conditions were rated as the most positive since 2021. And in fact, over the past 20 years, the liquidity conditions have only been greater than today at the peak of the COVID boom in mid-2021.
Elyas, long Mag 7 and long gold have been the most crowded trades for the past 3 months in a row. Yet at the margin, a small handful of investors now believe that being short JGBs and long global bank stocks are the most crowded trades. So I'm curious, it's notable given the impending BOJ rate hike at the end of this week, the near universal belief that yield curves are going to steepen across the globe. I mean, can you provide just a bit more color on these newly referenced pain trades?
Sure. I think if you look at in the details of the Fund Manager Survey, the one challenge where it's actually tough to square institutional investor bullishness is on expectations for bond yields. There is this big conviction that bond yields will be higher in 12 months' time. This huge conviction, net 75% see an even steeper yield curve, and then investors are very bullish risk assets. So, at the end of the day, it's important to take a step back and look at the big picture. And the most important question here, Damien, is can risk assets, global equities, US equities that are very rich in terms of valuation withstand 5% plus bond yields? And I think, at this level of positioning, at this level of valuation, risk assets will be struggling if the 30-year Treasury exceed 5%, which has been a line in the sand for US policymakers. But for now, investors prefer to focus on AI, the productivity gains that AI adoption will deliver, and in terms of EPS growth. And this is what they prefer to focus on, and is also driving their bullishness in 2026.
Elyas, despite the pro-cyclical rotation into equities and commodities, allocation to the energy sector is nearly 2 standard deviations below the 20-year average, according to your FMS. Yet with Brent crude now dipping below $60 this morning and most analysts calling for it to stay there, is there any benefit in fading that call?
It's one of the big contrarian trades of 2026. Really, the energy sector has seen a continuous underweight of FMS investors, and rightly so. Now, I think it's quite interesting to see the dichotomy between an increasing allocation to commodities. The net overweight on commodities is the highest since September 2022, but at the same time, a very big underweight on energy. And that dichotomy is explained by the divergence between metals and energy. I think in 2026, if growth surprises to the upside as investors expect, I think clearly there is a lot of value in the energy sectors, and probably the stronger growth will push the oil price higher.
On the flip side, Elyas, how much do you see a potential contrarian trade in bonds, in particular long bonds? This idea that maybe people are over their skis with how much growth could increase, and something's got to give. Either it's stock valuations or it's where bond yields are, and maybe it's the bond yields leading to a risk-off moves, something that people are sort of not positioned for at all.
Sure. I mean, what you saw this month, Lisa, is a very big rotation out of bonds, and also a big underweight when it comes to bonds, the biggest underweight since October 2022, when the MOVE index was above 160, i.e. rates volatility was a lot higher than it is today. And look, what is happening in this morning in the US, there is a big macro news, the November jobs report, and if that report surprises on the downside with a very weak payroll or even a negative payroll, I think that's the pain trade of the day. It's going to see bond yields sharply lower, and what I think is the biggest pain trade of macro investors, a flattening of the yield curve.
Yeah. Elyas Galou of Bank of America, thank you so much for being with us this morning. Really interesting, that survey, especially in light of sort of tepid enthusiasm right now, at least in futures, at the same time paired with unbelievable raging optimism for 2026.
Well, I mean, what we didn't ask, Elyas, was that the AI tech bubble now for 3 months in a row has been the biggest risk facing investors. But the biggest jump this last month was private credit, right? So, what about private credit? What about, these continuation funds? What about all the issues that are going on in that less transparent, more opaque, universe, and I think that's a tail risk that a lot of investors should be focused on here.
Elyas's partner Michael Hartnett said that you've only seen this level of optimism in this survey 8 other times in this century. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. The manhunt for the shooter who killed 2 students at Brown University is entering its 4th day. Rhode Island Governor Daniel McKee and other officials have said there's no clear security camera footage from the building where the shooting took place, which has hampered the search. The FBI is offering a $50,000 reward for information that leads to an arrest and conviction. Meanwhile, OpenAI's deal to license characters from Disney for its Sora video app is entirely in stock warrants rather than a cash licensing fee. That's according to people familiar. Last week, Disney announced it would let OpenAI pull from its library of more than 200 characters and creatures while agreeing to take a $1 billion stake in the company. And PayPal has applied to become a bank in the U.S. The payments firm is looking to take advantage of the Trump administration's openness to fintech companies entering the banking system. The company says, if approved, a PayPal bank would help strengthen its lending to small businesses. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahaira. Up next, counting down to the jobs report.
Payrolls we think are weak, and we think the risk is on the downside. Chair Powell's warning us, don't pay too much attention to the unemployment rate.
Stephanie Roth of Wolfe Research joins us next to tell us just how much attention to pay to the unemployment rate and other aspects of this report that could be potentially telling, given the fact that it's going to be messy and it is late. This is Bloomberg Surveillance. A soft tone to start the week, last week of the trading year, and we're continuing that this morning with futures lower pretty much across the board. 0.2% decline on the S&P futures. You're seeing a similar decline on the Russell 2000. The NASDAQ underperformance ongoing, down 0.3%. When you take a look at the bond space, not getting a reprieve here, and this is sort of the key. The idea of this incredibly accommodative backdrop that Elyas Galou was talking about this morning. Some questions about how persistent that can be with the 30-year up toward that 5% level, as he was saying, 4.85%, even with the 2-year at 3.5%. One thing that's notable, and Damien, I'd love your thoughts on this, the idea that when we started this rate cutting cycle by the Federal Reserve in September of 2024, 10-year and 30-year bond yields were lower when they are right now. Is there an indication in what that's saying?
Well, I think, it really, for me, it comes down to broad dollar weakness, right? I mean, look, as the carry trade, as we rightly point out, we were talking about offline, with U.S. yields now coming off, is the U.S. still an investment currency, or now is it a funding currency? And I think that remains to be seen. We got some weak data out of Germany last night. I think euro-dollar, that cross rate is going to be absolutely critical, and the data out of Europe is going to be absolutely key to the direction of the dollar and the durability of this dollar weakness over the course of the next year.
The data out of the U.S. also would have been important had we gotten it. We're finally going to be getting some of it under surveillance this morning, counting down to the jobs report.
Payrolls we think are weak, and we think the risk is on the downside. Chair Powell's warning us, don't pay too much attention to the unemployment rate. I think once we get the December data, we'll get a better reading. The risk is the labor market, though. So there you could see a little bit of weakness persisting.
Here's the latest November payrolls due out in just under 2 hours. The median estimate in our survey calling for 50,000 jobs added. What this means, though, pick 5 people, you get 5 different answers. Stephanie Roth of Wolfe Research expecting a higher number, 70,000. Stephanie joining us now. Stephanie, great to see you. Thank you so much for being with us.
Thanks for having me.
So what are we focused on? Is it the unemployment rate, even though Jay Powell said please ignore the unemployment rate?
It's probably going to be the private payrolls numbers, because the unemployment rate might be complicated, because if you think about the household survey this time, part of the survey week, it was still the government shutdown. Some people might say they were unemployed, even though they shouldn't have, given they worked for part of the week. So there might just be some unusual amount of noise, and BLS had flagged that there's going to be a little bit more error just given some of the complications with the shutdown. So the private payrolls is going to be a thing to watch. Government payrolls is going to distract from the headline number. So we have to watch for the private number for both October and November will be interesting.
Do you think that this market could be caught off sides, or do you think that this number is so messy as to be rendered useless once people digest it, trade around it, freak out, and then by the end of the day, things kind of go back to where they were before?
Yeah, I think the ultimate reality might be it's not so important, but there's going to be a lot of key details that we're going to learn about. The private numbers is going to be critical. We're going to be watching the cyclical hiring within the service sector, because that's what's been notably weak. Retail we're going to have to watch closely, because that might face some seasonal issues just around this holiday season might not be as strong for hiring as it typically is, just because retailers are a little bit more cautious. So there's going to be a lot of details to sort of parse through, but there's going to be a lot of information. We're going to be watching that quite closely to gauge to what extent the hiring might actually be starting to pick up.
Stephanie, I caught you on the real yield a few weeks back with Scarlet Fu, and you seemed relatively bullish on the U.S. consumer as we turn into 2026. I'm curious, consumer sentiment is now hovering near its lowest level since 2009. American households' view of their own personal finances are at near all-time lows. How bullish are you on the U.S. consumer here?
I'm actually pretty optimistic. This is an affordability issue, not necessarily a rate of growth issue. So inflation has slowed down. Of course, it's not 2%, but it's running around 3%. It's not growing as high as it was in 2022 and 2023. This is an affordability issue. Price levels are high, and that's something that people aren't happy about. However, they're able to largely afford, at least the middle to upper end consumers, largely able to afford most things, even though they're unhappy about the level of prices. And on top of that, we're going to have a decent amount of stimulus hitting the consumer in the first part of the year. If you think about the stimulus from One Big Beautiful Bill, it's going to hit around tax season. No tax on tips, no tax on overtime. That's going to be some decent amount of tax returns hitting the consumer.
In last week's Fed survey of economic projections, they increased their 2026 GDP by, I think, 0.8% without increasing their projection for the unemployment rate, which means it's all about productivity gains next year. Talk to us about that. Do you think that the Fed is a little bit too rose-colored glasses about the impact of productivity gains on GDP in the new year?
Yeah, so you have to knock off 20 basis points from their upward revisions on GDP for the government shutdown. But even beyond that, they did upgrade their GDP numbers, unemployment rate the same. I think that they're a little optimistic on productivity. I'm not quite as optimistic on productivity. I think what we'll see, though, is an economy that's growing fairly well. They'll just need to be a little bit more job gains to get there. And our sense is that adoption rates in terms of AI won't be as strong as maybe many people are thinking about it. It'll happen a little bit more slowly, such that
we'll actually see just a pickup in hiring, which is not such a bad thing.
We were just speaking with Elyas Galou of Bank of America, and he said that there's a real dissonance here between yields and the long end. They're close to 5%, and this bullish feeling that people have about the economy and how fast it can grow. Do you see the same thing, that there seems to be some sort of mismatch between the level of benchmark yields and how fast the economy can grow when people are talking about stimulus, despite the fact that long end yields have risen?
Yeah, I mean, so that is good. That is a bit of a challenge for next year. One of the pieces of our outlook when the 10-year yield was closer to 4% was an easing of financial conditions should help to support the economy. That's largely faded to some extent now that you've seen yields back up. Our sense is that we'll get, that will sort of take a little bit of the shine off of next year, but I don't think it will be that massive because there are a lot of tailwinds supporting the economy for next year. On top of the fiscal stimulus that will start to hit, you have investment that will start to hit, FDI pledges.
Core inflation.
Exactly. So there are a lot of different tailwinds that sort of support the economy, even though you have seen a bit of a pack up in rates. So the more cyclical, interest rate sensitive parts of the economy might still struggle, housing in particular.
How much is this sort of bullish feeling predicated on the idea that there is going to be, I want to say, a political tilt to the Federal Reserve and some of its actions with respect to supporting valuations? I'm thinking about how the balance sheet might be deployed, not just for T-bills, but also on the long end of the yield curve. This idea that if yields rise to enough, well, there is the ultimate Fed put, especially in 2026.
Yeah, I mean, I think that was some of the excitement after the FOMC. For me, that is not a fundamental reason for why I'm optimistic for next year. That, to me, is actually kind of concerning. And depending on how this all plays out, it could result in just upward pressure on the long end of the yield curve, which is not a good scenario. I don't think that they will end up really driving the backdrop that much. I think what we'll see is, let's say it ends up being a chair Hassett. At the margin, maybe that ends up being one more cut than would otherwise be the case. I don't think it will be that dramatic in terms of what the Feds end up doing. The key drivers of a strong growth backdrop is less tied to the Fed and more about a gradual cyclical pickup in the economy, tariff uncertainty starting to fade, the fiscal starting to play out in the beginning part of next year, and less about the Fed.
Stephanie, do you still believe that the reflation concerns that are currently gripping the market are overdone? I mean, do you still expect core inflation to decline in the new year? And if you still do, what are the drivers of that? Yeah,
I do. I think we're going to see inflation start to cool down. So housing is a big one. We'll see, rent and OER. They might bounce a little bit in this week's CPI, but our sense is it will gradually move slower throughout the course of next year. On top of that, goods inflation should start to cool a little bit. That has been held up by tariffs. Maybe not in Q1, but maybe throughout the course of next year. There's just a number of sort of components within the CPI that are just starting to normalize, in which case we'll end up in a growth backdrop where CPI is 2.7 by the end of the year and then slowing below 2.5% by 2027.
Stephanie Roth of Wolfe Research, thank you so much for being with us. Have a wonderful holiday season. And this disinflation is the reason why people are looking at the Fed and seeing them completely sort of not completely, but largely dismiss inflation as the preeminent concern and overweight the labor market.
Healthcare costs. I mean, that's going to be a big one if the Obamacare gets repealed. I think auto. I think shelter costs are still going to have pressure to the upside. I'm actually taking the other side of that trade, but that's just me. I
think there are a lot of people who would agree, and I think that your point about Obamacare is actually a significant one. How much does that eat into some of the candy that you're getting from the One Big Beautiful Bill and some of the stimulus payments? This is something people are parsing through right now, and will continue doing so as markets try to find their footing ahead of next year. A lot of optimistic feelings, not necessarily playing out in markets right now. Coming up next, Lucy Baldwin of Citigroup, Terry Haines of Pangaea Policy, Aiyengar of JPMorgan, and Mike Pyle of BlackRock as we head toward that jobs report. Payrolls Tuesday just doesn't have the same ring as Payrolls Friday. This is Bloomberg Surveillance.
Next year, there's more of a reason that we could see more broadening.
I think 26 is going to be more of a year where you're going to have to really think about stock selection.
Valuations coming down will be a reflection of a wider uncertainty.
This huge run in margin expansion could come to an end.
The pessimism gets wildly bad and then it gets wildly fantastic again.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Everyone's optimistic for 2026. This, according to the Bank of America Fund Manager Survey. Stocks, however, not keeping up, failing to keep the momentum into year end as investors look for reasons to get more bullish maybe in the next 12 months. Perhaps they'll find some reasons with the release of data. Finally, it's Jobs Day Tuesday. Of course, before that, we get ADP employment. Then, of course, we do get October retail sales. What do you look into that, given the fact that it's dated? And then on Thursday, CPI. Damien, we're finally getting the deluge that we've been hoping for.
Yeah, no, I mean, we needed some data to kind of lean into here. But again, you know, there's a lot of noise surrounding all of it. I mean, today's payroll data, I think the market's completely looked through it. I think actually retail sales might actually be a more important driver of people's models in terms of trying to gauge where U.S. yields are going to be in the new year.
People always say this. They say the data's not going to be that important this time. Then it comes out and markets go haywire.
4.7 on unemployment. Here we go.
I mean, right, exactly. Which is the bigger potential downside surprise to markets? If you get an upside surprise to the unemployment rate or a downside surprise that raises the question of just how much the Fed can actually cut again, if at all?
As I said, as we opened up today, good news is bad news for equities, right? Good economic data is bad news for the equity market and vice versa. And I think that theme is really playing through. It's really shown through in the last few weeks.
And that's what Mike Wilson of Morgan Stanley has been saying. Meanwhile, in the dollar space, you have seen the weakening trend reassert itself. And we saw this violent trend after Liberation Day in April. Now you're seeing a sort of a question about whether we could see a similar first half of 2026, raising questions about some of the most popular trades, AI, namely in the United States, and how much that is put at risk based on this move.
Yeah, no, exactly. I mean, look, the Bloomberg Dollar Spot Index is down 8%. DXY is down 9.5% this year. I mean, these are huge moves, but, you know, most of those losses are concentrated in Europe and Asia. I'm sorry, Europe and Latin America. Asia is only up 2.5%, the Asia Dollar Index. So, you know, you have to really pick your spots, and it's all in the eye of the beholder. If you're a European-denominated, a euro-denominated investor, it just hasn't worked that well for you investing in emerging markets and international equities. But it has if you're a dollar investor.
And this is a reason why people are looking ahead potentially to other pastures heading into 2026 if this dollar weakness does continue. Right now, it is on the margins continuing, at least versus the euro, at that 117 to 118 mark on the euro-dollar cross. S&P futures lower now just by 0.1%. Maybe people getting more enthusiastic as they hear Elyas Galou talk about the low cash holdings of all these fund managers. 10-year yields inflected just marginally higher. Still notable to see they're almost back to that 420 mark that we were at before the press conference by Fed Chair Jay Powell, 417.63, and crude falling to the lowest levels going back to earlier this year on expectations that maybe we can get some sort of peace deal with Ukraine and Russia. Coming up, we've got Lucy Baldwin of Citi as investors go just a touch risk off. Terry Haines of Pangaea Policy as the healthcare fight continues on Capitol Hill. And Mike Pyle of BlackRock as Wall Street eyes a fresh read on the U.S. labor market. We begin this hour with stocks edging just a touch lower ahead of today's jobs report. Lucy Baldwin, Citi Global Head of Research, is bullish heading into the new year, writing further upside is expected in 2026 as earnings growth broadens. But elevated valuations increase downside risk. Lucy joins us now. Lucy, this seems like kind of threading a needle. And thank you so much for being with us. And we keep hearing this, and it's sort of, diversify, be nimble. We're a little worried that everyone else is bullish, but we're bullish too. I mean, how do you sort of just frame your sentiment heading into next year, being bullish when you know how consensus that is?
Yeah, good morning. Thanks for having me. Absolutely. Look, after a couple of amazing years for the stock market, to be expecting another good year for US equities in particular does feel like it's a high bar. But ultimately what we feel is that the earnings backdrop for the S&P 500 looks incredibly strong. We, like many others, expect to see the Fed cutting a couple more times in the new year. And we think that is really quite bullish, really, to be cutting into that recovery. We think you're going to see the economy do pretty well in the first half of next year, again fueled by that fiscal expansion, the one big beautiful bill coming through, really helping to see growth move forward. So it is a pretty good Goldilocks type scenario, we think, for the equities market. Our view is you've probably got about 10 to 12% of upside for the US S&P, which is pretty good. And I think interestingly, we feel the tech leadership will continue to dominate, but alongside that, we believe you can see that broadening, both in terms of the US U.S. market itself, but also around the globe as well. We think you can have another good year for some of the other stock markets around the world as well as for the U.S.
Lucy, just because the Fed is cutting, do the policy rates ease, right? Do monetary conditions ease? And I ask this because even though we have had 175 basis points of rate cuts by the Federal Reserve, you've seen 10-year yields actually rise by more than 50 basis points in that period of time. You've seen 30-year yields rise by almost 100 basis points. So at a certain point, are we seeing tighter financial conditions in the margin the more that some of these central banks ease, kind of creating a little bit of a fly in the ointment here?
Well, at some stage, you're right. There is a risk that, for example, the fiscal situation, if you've got lots of questions around Fed independence, again, coming back on the radar next year, you could see that bear steepening start to be problematic for risk assets. But we think they're kind of like threading the needle at the moment, really, in the sense that you've got this sort of Goldilocks backdrop of good growth, inflation that's largely under control. Basically, you've got, that right mix of drivers. I mean, clearly, everybody's going to be watching certain things incredibly closely in terms of risks for next year. But I think if you can see that growth continue to be strong, corporate earnings continue to power on, it's really that ideal scenario where you're able to actually cut into a boom. Now, it is obviously a bit of a jobless boom, which I guess is the big question mark, right? And it's the job side of the equation that is ultimately allowing the Fed to be easing into what we think is actually possibly going to be this re-accelerating growth picture in the first half of next year, which of course is really rather unusual. And of course, let's not forget, this year's been pretty unusual too. It's been the everything boom to have had things like the US equity market up strongly, credit go up strongly, but then also you've seen ultimately things like gold have a phenomenal year, up 60%. So it's been an unusual year this year, and we do think it's going to be a delicate path, but one where you can see that continued risk on momentum, certainly into the beginning part of 2026.
Lucy, I'd love to talk about gold with you and precious metals because I know you recently had Max Layton, Citi's global head of commodity research, on your podcast, and he was talking about the firm's out of consensus view on gold in 2026, i.e. he's a bit more bearish than the street. I was listening to you and you didn't seem quite so convinced. I'm curious, the structural drivers that are underpinning the gold bull trade, I'm talking central bank buying, et cetera, do you expect that to continue, or do you see there room for downside in gold in the year ahead?
Yeah, look, I think, Max and the team have got some great calls going into next year, right? And one of those calls, as you say, is this view that actually the debasement trade has largely played out at these levels, right? And yes, you've got the structural central bank buying story, but ultimately there's probably going to be more upside in some of the base metals. Things like copper, that's the sort of perfect, clean, cyclical play, if you like, or aluminium, which is ultimately competing alongside the data centers for power. So you're going to probably see some positive price momentum there. So we just think there's more upside in those base metals rather than precious metals, and gold is obviously in that equation. So for us, that debasement story has obviously seen a lot of momentum this year, but we think, our core view is ultimately that the central bank remains independent and very data dependent. So even if you have a more dovish backdrop for the Fed next year, we don't think that debasement trade runs on materially more. I think you will see that sort of slow, steady re-diversification continuing for central banks, but I don't think it's necessarily enough to give gold from here significant legs as we go into the first half of next year. So I would be with Max and the team in terms of looking for other metals to really drive some momentum in the first part of the new year.
Lucy, you and the team at Citi have been a proponent of the carry trade, the FX carry trade, for a while now. I think you're still an advocate of it. Talk to us a little bit about buying the high-yielding currencies versus the low-yielders. I mean, I think 9 out of 11 months this year, the carry trade has worked out well. Can this continue? I mean, talk to us about rate differentials. Talk to us about, currency investing and what funding currencies stand out to you in the current environment.
Yeah, look, I think this is a big question after such a strong year, as you say, for sort of EM, FX and the carry trade. I think the conundrum we're all trying to grapple with is the dollar, right? We've had lots of debates on this. Dan Tobin, who's our FX strategist at Citi Research, he's got a really out of consensus call for the dollar, right? So that's quite interesting. He's much more bullish, the dollar, than pretty much the rest of the street. And it's quite interesting when our US chief economist, Andrew Hollenhorst, has still got 2 cuts for the Fed. So, what I think is quite a useful way of framing this is looking at what our macro strategy team says. So Adam Pickett, Dirk Willer, they talk about the dollar possibly going into next year, almost having a year of 3/3, right? So some risk that you get some weakness in the early part of the year as you're going into those continued cuts that we think you're going to get out of the Fed, 2 more cuts. And then they think, in that middle part of the year, you're going to see the dollar strength come back. And then maybe, to your earlier question, you get some risks later on in the year on the back of some of the steepening risk in terms of the back end of the US curve. So what does that then mean for EMFX? Well, I think, as we all know, right, it's very difficult for emerging market currencies to do well when the dollar is incredibly strong. So we're looking for those moments of opportunity really around that dollar backdrop, I think, when you're considering all the different options for different emerging markets.
Lucy, just quickly here, what's your black swan event that you're sort of gaming out that is an outlier case but could potentially be incredibly counter to consensus?
Well, I think the big events that we're all watching for is around the AI boom. There's the debate, is it a boom, is it a bubble? Look, we're in the category that we think, even if you categorize it as a bubble because of the moves we've seen so far, you still want to own it. It's still got legs. If you look at the valuations of the leaders of this boom, we don't think they look stretched, right? The earnings upgrades we've seen have been significant. If anything, people have underestimated the earnings power of these companies. And I think even up until very, very recently, it's all largely been funded out of operating cash flow from the big hyperscalers. I know we've sort of entered a new paradigm in terms of potential risk because we've shifted from the fiscal boom post-COVID into more of a credit expansion, and everybody's watching to see where the leverage is building in the system. But we still feel this has got legs to run for sure, and a lot of growth. We obviously also think long-term structurally huge productivity gains that can be unleashed by AI as well. So we're bullish about it, but we're cautious, and we know that obviously there is risk as other areas of that ecosystem take on leverage and take on risk. Some of the smaller names that don't have the operating cash flows of the big hyperscalers. So that's obviously an area where we're watching for risks to emerge very, very carefully and very closely. But generally, I think, we're pretty constructive next year. The other big macro risks, of course, we're watching for are around fiscal. We've just written a piece looking at the US debt position, an updated piece on the sustainability of that, because again, that's something that's going to be very important for markets as we go through 2026.
Lucy Baldwin of Citigroup, thank you so much for being with us. And that last point that you're making, a real salient one, and we'll get to that in just a moment. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. Rob Reiner's son has been arrested for allegedly killing his parents in their Los Angeles home. 32-year-old Nick Reiner is being held without bail. President Trump saying Reiner and his wife died of a, quote, mind-crippling disease known as Trump derangement syndrome. The comments drew wide criticism. Meanwhile, the U.S. military attacking 3 more alleged drug boats, killing a total of 8 people. The U.S. Southern Command saying the strikes were carried out in the Eastern Pacific at the direction of Defense Secretary Pete Hegseth. The operation raising questions about whether the strikes violate international law and whether the boats were actually carrying fentanyl. And Ford is taking a $19.5 billion in charges as it pulls back from electric vehicles.
The EV market in the U.S. went from 12% of the industry to only 5%. And that really, in the end, was the big decider for us. But look, we're going to 50% electric. It's going to be hybrids and E-revs and electric. It won't be just pure electrics.
Ford is also raising its profit outlook, saying cost cuts and a shift to more profitable vehicles are paying off. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahaira. Up next, a new fight on affordability.
The Republican legislation that will be on the floor this week does nothing to keep health care affordable for everyday Americans, and they know it.
Terry Haines of Pangaea Policy joins us next as we look toward the beginning of 2026. Which subsidies are coming, which aren't? This is Bloomberg Surveillance. softness to start the day, but really pulling back from some of the earlier lows. Futures just indicated a touch lower after yesterday really having a whipsaw session. Although as the session grows older, really, you can't keep a good stock market down. It seems like it's the story every single day. Almost flat now on futures. Seeing that dollar weakness continue close to that 118 mark. Euro dollar 117.64. Yield is marginally higher, although really stable here around the 417 level. Let's take a look at crude traded on the NYMEX. We have seen crude prices absolutely tumble on a glut of supply coming from OPEC, coming from the United States. We see a new low since May for New York crude traded on the NYMEX down at $55.98. And a real question here about how much this is supporting, Damien, the idea that costs are lower, that at the pump, you've got $1.99, as President Trump was saying, kind of supporting the disinflation narrative.
Well, more supply is coming online, Lisa. If you look at LatAm, offshore drilling off of Brazil, shale in Argentina, I mean, you can quantify this, and our friends at JPMorgan have. And if you look at the average price for Brent crude in 2022, which was about $100, it's now down to this year $65. And if you listen to them, it's going to be $50 to $55 range next year. So, build that into your models. And what does that mean for inflation, specifically in emerging markets? I mean, there's your growth stimulus.
Right, and that's the reason why people keep watching what organizations like the International Energy Agency, what they say. They said recently that the size of the surplus in the oil market will be a new record next year. So really giving a sense that this could persist. Meanwhile, real question here about affordability more broadly. Under surveillance this morning, a new fight on affordability.
In just 2 weeks, tens of millions of Americans are going to experience dramatically increased health insurance premiums because of the Republican refusal to extend the Affordable Care Act tax credits. The Republican legislation that will be on the floor this week does nothing to keep health care affordable for everyday Americans, and they know it.
Here's the latest. Lawmakers scrambling to reach a health care solution with enhanced subsidies set to expire on New Year's Eve. The House preparing to vote on a slimmed down health plan this week. Bloomberg's Tyler Kendall joins us now from the nation's capital. Tyler, do we have a sense of what the ramifications will be should these subsidies not be extended as widely expected?
Yeah. Hey, Lisa. Good morning. Well, our Bloomberg News estimates puts it at about 20 million Americans that could see their premiums spike if we do go over this so-called Obamacare cliff and the subsidies do expire. And at this point, it does appear increasingly likely that's going to happen as this White House has faced political pressure when it comes to the issue of affordability. This is really only going to compound it for Republicans as we head into the midterms. And that's why we're seeing right now two efforts brewing on Capitol Hill to address what many have said is going to be a healthcare crisis for millions of Americans. On one end, we're watching this vote that's going to happen in the House, this Republican-led package that does not include an extension of those expiring tax credits, despite demands from moderates that one should be included. Instead, we've heard repeatedly from Republican leadership that the plan put forward doesn't have those necessary pay-fors to offset the spending. So instead, they're pushing a separate proposal that does include plans to lower healthcare costs through other initiatives such as regulations on pharmacy benefit managers. The thing is, that's not actually expected to pass. It's likely going to fail, which means that the conversation continues, which actually leads us to this last-minute meeting that we saw last night on Capitol Hill among a bipartisan group of senators. And this is going to be a really important one to watch because senators came out and they said that their goal is to get a plan out this week, but likely not hold a vote until next year. The proposal on the table would be a 2-year, essentially retroactive extension to these expiring tax credits. I spoke to one aide who told me that maybe this could happen through some sort of rebate. We're still waiting on details there, but it would include those structural changes that Republicans want to see, such as an income cap or anti-fraud protections. Lisa, the thing is, though, the White House, we know, would probably like to see something different. President Trump has often said he wants more money going directly to American consumers. The thing is, he hasn't weighed in directly on any of these plans or thrown his real-hearted support among any of them, which means that this debate is going to continue to drag on. This is the last legislative session of the year. Lawmakers aren't expected to come back here to Washington until at least January 5th.
Tyler Kendall, thank you so much for that. Joining us now, Terry Haines of Pangaea Policy. Terry, how much are people counting on the idea that subsidies are going to fall away and healthcare costs are going to increase when they talk about stimulus coming down the pike in 2026?
Well, a couple of things, Lisa. One is that, work expands the time allotted to fill, and they've got a few more days here at least, or maybe into next week. So legislatively speaking, that's a lot of time. The mishmash of everything that's in front of them suggests a solution of a small bump in the current subsidies, bump forward into 2026, combined with a number of other things. But what markets ought to understand is that this is one step in a two-step game. There's almost certainly going to be a big, beautiful bill 2.0 next year. I think as early as the first quarter. Senate Budget Chair Graham's already been talking about it, and already been talking about the need to do some more on Obamacare subsidies and on Medicaid next year. So what you're going to see here is a very interim Band-Aid solution. I think a little bit more likely than not, combined with the more likely 2.0 solution coming early next year. So there's going to be a lot of volatility in healthcare stocks as a result of that, but that can't be helped.
Terry, in yesterday's Wall Street Journal interview, Trump stated that he's not sure if his handling of the economy is going to cause the Republicans to win the midterms. He's all but conceded defeat there. And I'm curious to hear your thoughts about this big, beautiful bill 2.0. What type of reforms, what type of legislation can we expect to find in that?
Well, a couple of things, Damien. First, I'd suggest that the jobs report may play a role in deciding what happens in the Congress this week. If the economy looks weak going into the holidays, I think there's probably a greater desire to do something to push back against that. On healthcare, precisely for affordability reasons. Secondly, what you have here, and there's already been some discussion on your program this morning about this, is you're going to have a lot of stimulus happening early in 2026. On top of that comes from the 2025 bill. On top of that comes 2026, which Graham describes as a little more of everything, a little more entitlement reform outside of Social Security, other than Social Security, a little more on Medicaid, a little more on tax, including expensing, a little more money for the military, probably something, if Graham has his druthers, on a minimum tariff, and I would suggest a lot more on onshoring manufacturing incentives, because that is key to speeding a more robust U.S. defense industrial base.
Terry, Polymarket currently assigns just a 27% probability that the Supreme Court is going to vote in favor of Trump's tariffs. This is down from a high of 53% just a few months back. What's the timeline here for SCOTUS, to give us any color? How do you believe the market's going to react if Trump's tariffs are voted down?
Well, I think, Damien, a couple of things. One is I wouldn't rely on Polymarket too much. That's if you're sitting around a roulette table, that's a bunch of people kibitzing behind you. So fundamentally, so would you rely on them for your results or for your advice? I'm not sure. But beyond that, I always push back against the idea that the court presumptively rules against Trump's tariffs. I think that's based on a flawed assumption that the court doesn't take the economic emergency seriously. So I think what happens is, at the very worst for the administration, they say they can't put the tariffs in place using that IEEPA authority, but there's plenty of other tariff authorities. Secondly, I think they probably give the Congress some time to fix the statute, and that's something you can do also in that 2.0 reconciliation bill.
Terry Haines of Pangaea Policy, thank you so much for being with us. And Merry Christmas. I see the stockings hanging behind you. Do you trust the people kibitzing behind you? Polymarket?
Well, I'll tell you this about Polymarket. People are risking capital there. So whether they're right or wrong remains to be seen. Maybe Terry should take the other side of that trade on Polymarket. Maybe 27% is too low.
Coming up, we'll be talking about M&A. We'll be speaking with the head of advisory and M&A for JPMorgan. This is Bloomberg. little bit of softness, although throughout the session we've seen a bit more optimism bleed in. Perhaps they read the Bank of America Global Fund Manager survey that showed that cash holdings were down to an allocation of 3.3%, the lowest on record. What you are seeing is S&P futures barely lower, less than 0.1%. Similar declines in the NASDAQ and Russell 2000, so really pulling back from some of the earlier lows in the 2s, 10s, and 30s space. A real question about what the ramification, bigger risk scenario is from the non-farm payrolls report that we don't get on Friday. We get today at 8:30 a.m. Eastern. Right now, a real expectation that any kind of increase in the unemployment rate or decrease in the private payrolls figure could increase the chance of a Fed rate cut in January. 350 on the 2-year, been pegged around there. We have seen that 30-year yield continue to climb up just day by day, 4.85%. And if you take a look at crude, falling to the lowest since earlier this year, falling significantly this year, 22%, as we look toward oversupply. The idea that the IEA is saying that next year the glut in the oil market is going to be the most on record. 2 hours away from the cash open, here are your morning movers with Yahaira Anand. Yahaira.
Hi, Lisa. Ford is ripping up its EV playbook and refocusing on gas and hybrids. And investors are buying the story this morning with the shares up 1.1% in the pre-market. That's despite the company taking a $19.5 billion hit as part of the overhaul, which will include it scrapping a planned electric truck and repurposing a battery plant. Meanwhile, moving on to Zillow shares, they had their worst drop in 10 months yesterday and are still falling today, down about 1%. On this report that Google is testing a new real estate advertising format that could compete with Zillow. The report says that Google is putting listings directly in search results and putting full property details along with it. Meanwhile, we end on Gap shares. They are rising 2.2% on some sell-side action, with Wells Fargo upgrading the stock to overweight and setting a $30 price target. They're saying that they're seeing real momentum at Old Navy and Gap, and there could be extra upside if tariffs are repealed. They're also saying that Gap is one of their favorite long ideas. Lisa.
Thank you so much, Yahaira. On our radar this morning, NASDAQ looking to extend its trading hours to 23 hours a day. The firm asking the SEC for permission to add a trading session from 9 p.m. to 4 a.m. Eastern. Damian Sassower will be awake. NASDAQ expecting to be ready for extended trading in the second half of 2026. Not a huge surprise. I mean, this is the modern age. Everyone needs to be doing everything all at once.
Well, the New York Stock Exchange is going to be doing it also. They're all following in the heels of Robinhood and Interactive Brokers. But what's interesting is, will the DTCC be ready to clear those trades in time for this to actually go live in 2026? I mean, we're talking clearing. This is not easy. This is hardcore settlement of huge block trades. It's going to be more complicated than that.
Yeah, and if you open, will they come? Because people maybe are going to be asleep and then you won't have the liquidity. Meanwhile, PayPal applying to become a bank in the United States. Approval would help the firm bolster its small business lending capabilities. The company has provided more than $30 billion in loans and capital since 2013. PayPal also looking to offer interest-bearing savings accounts. I remember when people looked to intermediate the banking sector. Now they're joining it.
Well, this comes on the heels of those preliminary approvals for those crypto firms, right? Like Ripple and Circle getting applications last week. And I think earlier this year, Sony and Nissan Motor also applied for and received the banking license in the U.S. So legislation is becoming a little looser, allowing some of these entities to list as a bank here in the U.S.
Yeah, my oldest son tried to apply to me to list as a bank, and it was rejected. OpenAI's deal to license Disney characters for its Sora video app is entirely in stock warrants rather than a cash licensing fee. The terms aiming to align both companies' financial incentives. Disney is taking a $1 billion stake in OpenAI, and we want to stick with the deal picture because we've got the person who really has the best handle on this space that is going to be incredibly active in 2026. Global M&A transactions rising about 40% to $4.5 trillion this year. And the mega merger landscape could grow even larger in 2026. Anu Aiyengar is JPMorgan's global head of advisory and M&A, and she joins us now to discuss this inflection point in deal making. Anu, thank you so much for being here.
Happy to be here, Lisa.
So let's start with just how much more space there is for the likes of some of the mega deals that we've heard announced, how much more appetite there is in capital markets, and how many potential contenders there are still out there.
Yeah, it has been a bit of a roller coaster ride. Sitting here today, it looks like a fantastic M&A market. But if we were having this conversation even 6 months earlier, I think the picture would have looked dramatically different. We've seen an increasing trend. Really, the conversations in the boardroom kind of picked up in May, and you saw the printing of the deals happen August onwards. And every month has been bigger than the previous month, to now 70 what we call mega deals, right, rather than $10 billion deals, which is an all-time high. But yet, while the volumes are 40% up, the number of deals itself has actually been down, right? So because of this mega deal trend that you see. Having said that, what is driving that? Why are people focusing on scale? The equity markets have really given a premium to scale. The size of a company to join the S&P 500 has tripled. The size of a company to join the S&P 600 has doubled in the last 5 years. So that's a pretty dramatic focus on scale. And people are not just chasing size for the size sake, because it's not any type of scale. It's strategic scale, focused scale. Because at the same time that you've seen these scale transactions, the market has also wanted corporate clarity. You've seen spins, splits, reverse mortgage trust transactions. So sometimes it can be a bit confusing, right? Okay, you want scale, but at the same time you want focus. Like, how does the two things come together?
What's fascinating is a lot of people have taken a look at the M&A schedule and said this indicates CEOs feeling confident about the economy, feeling confident about capital markets. The way you're framing it sounds slightly different. It's the idea of an opening to get in on a scale game at a time when that indicates resilience. Post-pandemic, post-tariffs, the more scale you have, the more ability you have to negotiate and be nimble. How is that different than just screaming confidence about the economic cycle?
No, you're exactly right in that the driver of it is not, I feel good about the world, let me go do M&A. The driver here is very different. The driver is that scale allows you to have more control over your supply chain, allows you to get synergies and invest more in tech capabilities. The amount of AI infrastructure investment that the economy has needed these are big numbers. So to make this type of capital investments, companies need synergies from this combination to do that. And when the external environment is so volatile, there's a lot of uncertainty. That hasn't gone away. Larger companies are able to withstand the risk in the system better and navigate it better. So there's a reason why the market is giving a premium to scale. And that's what people are chasing. So most of these deals are not, people thought of this deal today. These deals have been, there are files and binders put together over 5 years where CEOs have said, this is a company that we should buy, but I don't know whether they are open. I don't know whether other people will look at it. Is it the right time? Will my investors support it? And these are finally happening now because there's also an expectation that in addition to the market rewarding scale, the regulatory environment may be, in certain cases, easier to navigate. So you take kind of the combination of all three factors, right? External market risk allows you to navigate better when you have the scale, and market values scale and gives you a valuation premium, which has been an all-time high, the scale-related valuation premium, and a regulatory environment that may be more favorable for M&A. Put all of those things, and that's the perfect recipe for the market that we are in.
Anu, JPMorgan chief interest rate strategist Jay Barry is calling for the Fed to cut rates again in Jan before pausing to take stock of the economic outlook, right?
Yeah.
And I'm just curious, how are interest rate expectations shaping the boardroom when you're having conversations with JPMorgan's corporate clients?
Yes, I think this has a bit more of a focus on the private equity community and sponsor activity. For most of the strategic deal activity that is happening, there is no dearth of financing, or that is not a big consideration, that interest rates are going to be 25 basis points here or there, because people are taking a long-term view on what is going to happen in my industry sector. How do I become an endgame winner? What are the chessboard moves? On the private equity side, there has been a little bit of, you've seen that we haven't had as many monetizations in 23 and 24, and there's a lot of pent-up assets waiting to find monetizations. Even though, at the same time, you also see take-private activity, right?
Yeah.
And you may wonder, how does it make sense to do take-privates? Because every day you're talking about S&P at record highs and NASDAQ at record highs. Having said that, there are some companies which are at record highs, but there's a significant part of the market which is not. They are trading at a deep discount to the 52-week high. And the scale issue, if you're a sub $5 billion market cap company, there's a lot of companies in that space whose public market valuation doesn't reflect their true value.
Well, Anu, you mentioned financial sponsors, and I hear you. They are sitting on record levels of dry powder.
Yes.
But private credit is consolidating, and private equity fundraising has been sluggish, to say the least. So talk to us about which sectors are going to drive the deal cycle as we look ahead to 2026.
So these mispriced public securities are still an opportunity. And then another interesting trend you've seen is the partial monetization and continued ownership, and every version of that. We were talking earlier about continuation funds being one element. So this year, 20% of the sponsor monetization has been through continuation funds.
Right.
And the secondary market has increased significantly to now you have several GPs who are raising secondary funds. So that's going to be a pretty interesting dynamic, right? Because earlier, there was a sense that, an asset that I cannot take public or I cannot sell, I may put in a continuation fund. Right. Whereas now the dynamic has shifted to some people saying, look, this is my best asset. Why is it that I'm selling that one and keeping the rest? Maybe this is the one that I should put into a continuation fund. And the amount of money that is available in the liquidity in the secondary market is extremely high. So some very interesting dynamics happening in the broader private equity space at the same time when many of the private equity companies itself are transforming. They're all now alternative asset managers, right? They are not just in the LBO activity. In fact, for some of the large funds, LBO activity is a small slice of what it is they do, and they play across the capital structure as well. So that has changed the flavor of both deployment and monetizations.
Just quickly here, Anu, next year, do you think it's going to be as great as people think in terms of so much more M&A volume than it was this year, incredible deals activity, and a broadening out beyond the mega deals?
So the momentum is very high, and when we look at our pipelines, both on the strategic side as well as the sponsor side with the number of companies that need to monetize, it's very high. Having said that, there are risks, right? We are still in the middle of several geopolitical conflicts. There has been a favorable environment, interest rate cuts, all of this that people are expecting and pricing into the market. And there is also this question of what happens with the amount of money that is going into AI. I read a very nice quote from somebody which said, AI's New Year resolution is ROI. And I was like, that's about time, right? You think about what is the return on all this money that you're putting in? What should the KPIs be? How should I measure the impact and result? So there are some things that you have to watch to see if this trend will continue, but the appetite is there, interest is there, and the financing markets are there.
Anu Aiyengar, thank you so much for being here. Hopefully we can do this again. JPMorgan's Global Head of Advisory and Mergers and Acquisitions here in New York. Right now, let's get you an update on stories elsewhere. Here is Yahaira Anand with your Bloomberg Brief.
Hi, Lisa. President Trump is classifying fentanyl as a weapon of mass destruction in his latest push to ramp up pressure on Latin America over drug trafficking. Trump allies saying such a move can open up access to funds appropriated for detecting and eliminating weapons of mass destruction. Meanwhile, Kraft Heinz announcing a shakeup to its C-suite, tapping former Kellanova boss Steve Cahillane to take over as CEO on January 1st. He's stepping in to navigate the company's massive plan to split into two separate entities. The move comes as the food giant struggles to win back shoppers who are ditching processed staples for healthier options and cheaper brands. And in sports, the Pittsburgh Steelers beat the Miami Dolphins on Monday Night Football 28-15. Quarterback Aaron Rodgers had one of his best games of the season, throwing for 224 yards and 2 touchdowns. The Steelers improved to 8-6 and remain atop the AFC North, while the Dolphins are eliminated from the playoffs. The Steelers haven't lost a Monday night game at home since 1991. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, the labor market mandate.
They will have to keep cutting interest rates if we don't see any strength. We expect the October payroll to show contraction of 60K, which then rebounds into November, but that does not paint a very good picture of the labor market.
Mike Pyle of BlackRock joins next. This is Bloomberg Surveillance. The longer the session grows, the more people take a look at stocks and say, well, maybe we still will get a Santa Claus rally. Right now, futures had been lower by as much as 2 or 3 tenths of a percent. Right now, less than 0.1% on S&P futures. Dollar weakness continuing and building close to that 118 mark on the euro-dollar cross, and 10-year yields actually now getting a bid, 4.16% lower by almost a basis point. Under surveillance this morning, the labor market mandate.
The Fed's mandate is not what headline GDP is doing because of all of the capex investment we're seeing. The Fed's mandate at the end of the day is labor market. They will have to keep cutting interest rates if we don't see any strength. We expect the October payroll to show contraction of 60K, which then rebounds into November, but that does not paint a very good picture of the labor market.
Here's the latest. Investors looking to gain clarity on the Fed's direction in 2026 from the November payrolls report. Mike Pyle of BlackRock saying continued softness in some of the labor indicators could bring another 25 basis point cut into the mix for January. Mike joins us now for more. Mike, great to see you. Thank you so much for being here.
Great to see you.
So I hate to do this, but is bad news good news for markets if we do get potentially a 25 basis point cut in January? I'm sorry, and I'm sorry, Stuart Kaiser.
So, I mean, I think what I'd say is, listen, there is definitely a world where activity continues to be relatively on the firm side, where the labor market is comparatively soft, and that opens the door to additional easing from the Fed and financial conditions. And that mix of relatively firm activity and relatively easy financial conditions historically has been positive for markets. Not that that's going to occur, but there's definitely a clear pathway to that kind of outcome as we look forward the next 1, 2, 3 months.
Mike, in late October, you made the case for buying a basket of hedge funds or hedge fund strategies to build ballast into diversified portfolios. And you and I both know the difficulty with investing in hedge funds. I'm talking lockups, gates, subscription fee, everything. Talk to us about how you would go about doing it. Are there ETFs? Are there index funds? Are there easier, less expensive ways for, a high net worth or even a retail investor to get access to the asset class?
Yeah, so I think the key point is to say diversification is hard in this environment, and on balance, market neutral strategies can be a key way of building diversification in portfolios in a world where traditional diversifiers like long dated government bonds may be less reliable looking ahead. There are a range of ways of doing that. There are liquid alternative portfolios. There are kind of more traditional hedge fund portfolios. But the key point is there are a range of access points to finding strategies that are more market neutral, more geared to this moment in macro. And I think that's an important element of what investors should be looking for.
Mike, dollar weakness. I mean, you travel all over the world. I mean, you speak to some of the biggest, largest institutional investors. We know what happened post-Liberation Day about the FX hedging. All the foreign investors in the U.S. equity market started hedging their portfolios again. How are they doing that? Are they using non-deliverable forwards? Are they using options? Are they doing it in a conditional way? If you're a foreign investor and they come to BlackRock and they say, we need to hedge our exposure, how do you recommend they do that?
Yeah, so I mean, I think the theme is exactly right. And I think what we consistently hear from investors around the world is we want to maintain our exposure to U.S. equity markets. We think that there's something unique that U.S. equity markets are providing that we can't source elsewhere globally, in particular, a set of technology and AI exposures. But, we're more cautious on the dollar. And, I think oftentimes that means that, they've let their hedge ratios kind of run with the market run up in the U.S. And it's more just a matter of kind of getting back to home base with their traditional hedging programs rather than necessarily doing something kind of meaningfully new or different. I would offer one additional point, which is, I think it's noteworthy that 2025 has been a year of dollar softness, but most of that dollar softness was built into the first few months of the year. It's really been steady as she goes since the summer, and steady as she goes even in the face of the Fed being kind of more aggressively priced into markets. And I think that's noteworthy. It's suggestive of something else we've been saying all along, which is, the dollar has been softer, but we shouldn't overread that the bid for U.S. assets, including the dollar, on balance continues.
Well, how much does this really raise a risk, though, heading into 2026? The idea that people have put that story aside of the dollar debasement trade and really look toward the AI growth, some of the strength that we could see in the economy and the stimulus as being a positive. Do you think that that is the trade to follow, or do you think that's the trade to lean against?
So I'd say it's both and. Simultaneously, a key driver of returns in 2025 and likely in 2026 and beyond is going to be that core technology exposure, that core AI exposure, which again, rooted in U.S. equity markets. At the same time, particularly with U.S. equity markets and global equity markets becoming more and more concentrated, it's important to be really intentional about how to size that exposure and build diversification. And that's why, to your earlier question, Damien, that balance between sourcing that core driver of returns around AI, but balancing that and diversifying that in an intentional way, including through things like market neutral strategies, we think is the right way to be building a portfolio as you go into 2026.
It seems like right now investors think that you can have your cake and eat it too a bit with the idea of stimulus coming down the pike, fiscal, monetary, as well as just a better than expected backdrop for GDP. Scott Bessent talking about 3.5% GDP growth by the end of next year. At the same time that people don't think that inflation is going to be a problem. What has to give, or is this actually a correct way of looking at the universe, that you can have growth, you can have rates at this level without seeing inflation kick off or some potential pushback to monetary policy easing?
So, what I would point attention to, which is something we've been drawing attention to, is, just how unusually wide the potential range of outcomes is on the macro side. And you need to look no further than the dot plot at last week's Fed to see how true that is. I mean, there's always, some divergence of opinion among members of the FOMC. But if you looked at the dot plot last week, whether it's 2026, 2027 or the longer run, really historically wide kind of variance in terms of where members of the FOMC think the Fed might go. That is reflective, I think, of just a broader theme, which is the macro environment is unusually uncertain. The traditional macro anchors that have undergirded macro asset allocation are more unstable than they have been for some time. And that's why this kind of approach of, identifying those core sources of return like AI, but also taking a pretty intentional approach about where to source diversification in an unusually uncertain backdrop is, we think, both new and different and hard, but also the right way to go about it.
Mike Pyle, wonderful to see you. Thank you so much for being with us this morning. Mike Pyle of BlackRock joining us here. And that diversification we keep hearing time and again. Paul Quinsee of JPMorgan saying the same thing, looking for new sources to try to counterbalance some of the overweights.
But staying mindful of liquidity, right? Because, it's one thing to say I'm just going to invest in anything, but the liquidity of that asset class and building sort of a liquidity profile, I think, is absolutely critical given just how volatility has come off in this year and probably will remain low next year.
Right now, visibility hasn't been exactly great, especially without data. We get some data coming up. We do get that payrolls report in about 35 minutes time. Coming up, we got Mandy of CBOE, Michael Collins of PGIM Fixed Income, Francis Donald of RBC, Jeff Rosenberg of BlackRock, all responding to the economic data that we have been waiting for. From New York, this is Bloomberg Surveillance. Good morning.
Payrolls we think are weak, and we think the risk is on the downside.
Our own forecast has the labor market looking quite resilient in 2026.
The Fed's mandate is not what headline GDP is doing. The Fed's mandate is the labor market.
If the labor market is clearly weak, the Fed's cutting a lot more than what's priced in.
The Fed is not going to solve the labor market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
30 minutes to go until we get the data that we've been waiting for more than a week. Good morning. Welcome back to Bloomberg Surveillance. Everyone's optimistic for next year. This, according to the Bank of America Fund Manager Survey. Stocks haven't been keeping up. They're sort of flirting with momentum this morning into year end as investors look for a show me moment. Perhaps they'll find a show me moment in the data. Finally, we are going to be getting that non-farm payrolls report. Of course, we're also going to be getting October retail sales. All of this incredibly dated. Nonetheless, Damian Sassower, who has been a alongside me for this ride. Honestly, at least we get something. And I think that's what a lot of people are looking for.
Yeah, I think the markets have looked right through it. I mean, if you check my Aura ring, it's probably, I've been sleeping through most of today. I mean, I think it's really about options. It's about volume. It's about volatility. And we've got some great guests who are going to tell us all about what the market's telling us.
Yeah, right now the market's telling us that it wants to see some action. It is basically range bound as we head into that key question. Right now we see just a little bit of a decline in the S&P futures, lower by less than 0.1%. Meanwhile, dollar weakness continues and builds almost at that 118 level. A bid into bonds 416 and crude at the lowest levels going back to May. A key round of data on deck today, as we were just talking about. Francis Donald of RBC writing, we expect that 93,000 jobs were added to the U.S. economy in October. For November, we expect that an additional 89,000 jobs were added. We anticipate that the unemployment rate will hold steady. Francis is our guest host for the hour. Francis, thank you so much for being here with us.
Thanks for having me.
Great to see you. So just to start off, I mean, what is sort of your expectation and what are the details that are most important in today's report?
Well, there are two jobs for economists right now. What is non-farm payroll is going to print on our screens, and then what's happening in the underlying economy. So our estimates might sound really bullish. They're not effectively. We know that these numbers are probably overstating to a certain extent. They will get revised downwards, and we know that a lot of the job creation is structural sides. Healthcare, for example, that are adding. If we get a big number today, it's not necessarily a reflection that this economy is firing on all cylinders. And so there's two jobs. There's, of course, what the number will say. We say 90,000. And what's actually happening, which is probably the labor market is weakening under the surface. And what we look at today is going to be the sum of so much information from retail sales to non-farm payrolls to try to give us a sense of just how much it's weakening under the surface.
I just wonder how much people are going to look at the data and say, hold on a second. Yes, okay, we get 50K if that's what we get. We get this idea of an unemployment rate rising to 4.5%, but it's so messy that it doesn't really change anything based on the other information that we're getting. Do you think that that's going to be the narrative coming out of this?
Well, it certainly keeps economists employed. And the number that I keep thinking about is 40,000. 40,000 is our estimate of break-even employment, which is effectively how many jobs does this economy need to create? And are we creating more or less than that 40,000? So every time I see a non-farm payroll estimate, my guess is it going to be above or low? That's going to actually determine where the unemployment rate is on a go-forward basis. That's what will matter to Americans, to the Federal Reserve, and ultimately to markets.
And what about inflation? What about CPI? We get that print at the end of the week. And look, I mean, we do get another payrolls print before the next Fed meeting. I mean, talk to us about the importance of those two kind of events between now and middle of January.
I'm more focused on CPI because of what it will tell us as to where we're going next. But the story with inflation is really an uncomfortable one, not because it's too high or too low, but because it's kind of stuck in that middle. We see inflation really navigating around 3%, a little above in the first half of the year, a little below in the second half. What do we do with that? Well, it depends how the Federal Reserve responds to it. And how do consumers respond to it? Well, it depends where that inflation is. Is it going to be in food prices? Is it going to be in electricity? Well, that's going to be more painful for this consumer base in the U.S. than, let's say, if it's in autos or purchases that we make every once in a while. So the composition of inflation, I think, is going to become even more important on a go forward.
And a real question here about what markets are pricing for. Francis Donald of RBC, you're going to be sticking with us for the hour. Coming up this hour, Mandy Zhu of CBOE Global Markets with stocks just edging a touch lower. Michael Collins of PGIM Fixed Income as investors await that November payrolls report. And Jeff Rosenberg of BlackRock and what the latest data means for interest rates for the Federal Reserve. We begin this hour with stocks looking to avoid a third straight day of losses. Mandy Zhu of CBOE Global Markets saying despite the recent slide, AI fears are subsiding within the options market. She writes, even on Friday's pullback, most of the flow we saw was investors stepping in to sell volatility. Mandy joins us now. Mandy, great to see you. Thank you for being here.
Good to be here.
So before we get into the AI trade and the broader sort of markets, I'm just wondering how the market is positioned right now from a derivative standpoint heading into this labor market report. What would the bigger surprise be?
I think with how they're positioned is not expecting a whole lot from this number. So if you look, for example, at our VIX one-day index, which tells you how much volatility is being priced in for the next 24 hours, it closed at around 12 yesterday. So that's pricing in about a 75 basis point move for today. That's not a lot compared to how markets historically have reacted to payrolls, how they have reacted this year. So I think what the options market is telling you is that regardless of what the number says, it's not really going to change the pricing for the Fed. It's not really going to change the overall narrative too much, given that part of this data is stale. And I think the Fed's going to wait for more data before the next meeting.
What's interesting to me is this idea that markets are looking much more to earnings and less to the economy. And we see that increasingly, that this is a market driven on AI investment and efficiencies. And honestly, if you get a jobless recovery, it's not a problem. At what point does that change, or is that really the new market dynamic?
I do think it will eventually change. So one of the key themes that we've noted for this year is people really underpricing kind of the macro risks. If you look at implied correlations in the market, it's at historic low levels. Basically, that's the market telling you that this year it's all about single stocks. It's all about earnings, fundamentals. It's all about thematic trade AI. But I think, and it kind of depends on where the AI trade goes. But I do think next year, if, as we know, labor market is weakening, depending on how much it weakens, could we see more correlation being priced into stocks? That will boost index volatility. That will give, a higher floor to the VIX. So that's something that we're watching to see how much macro risk is being priced into the market versus idiosyncratic risk.
Mandy, we began the conversation by talking about today's event risk, and you referenced the zero-day options market, which, by the way, is a $2 trillion market, up 70% year over year.
Yeah.
Who are the marginal risk takers in that market? Is it retail?
Yeah.
Is it institutional? Talk to us a little bit about the read-through in terms of who's actually taking advantage of that market and what it's telling us.
Sure. It's actually fairly balanced. So from what we see, about 50 to 60% of the flow is actually coming from what we think are retail investors and 40 to 50% from institutional investors. And that, I think, surprises a lot of people because index options and options generally historically have been more thought of as sophisticated institutional tools, but one trend that we've seen over the past 3-4 years is retail getting more and more involved with options and more sophisticated in how they're trading options. I think a lot of people have this incorrect assumption that retail is just using options to speculate. They're buying options, take a view on the underlying market, but we actually see very, very diverse strategies being employed, both retail and institutional through, spreads, selling spreads for income. They do sometimes speculate, but it's very balanced, and people use it for hedging purposes as well.
Well, Mandy, you were taking me right to where I want to go. Vol is at historical lows or near it in equities and rates and FX, you name it. But talk to me about the cost of putting these custom baskets, these hedge structures on. In your professional opinion, are they indeed getting less expensive, or are there just more option legs to the custom basket, which is basically keeping things inflated? If I'm an institutional investor and I come to you and I want to buy some, recession hedge, has the cost for that really cheapened in this environment?
So if you look at the cost of hedges, they have cheapened because overall levels of volatility have gotten lower. Where we are seeing hedging demand is really kind of tactical hedging. So going into year end, we've seen really a pickup in hedging demand. But if you look longer out, like say 3 months, 6 months, really not seeing a ton of hedges being put on in this environment. And the cost of hedges actually fairly low by historical standards. And then when terms comes to custom basket, that is a theme that we've seen a lot. People looking to trade themes in the market in a more efficient way. Now, if you're an institutional investor, sure, you can go to a bank and get a custom basket on. But what we've gotten a lot of demand is a more effective way of trading that. So we actually recently launched last week our Magnificent 10 Index Options, which is an index of 10 tech and AI stocks that give people a more effective way of trading that theme. Now it's just one index, one underlying. And for retail who can't access, thematic baskets, I think that's also a great tool in order to really trade and hedge this tech AI theme that's kind of on everyone's minds.
Francis, I have to say, as I hear Mandy talk, all I think is no one's worried. No one's worried. No one's worried, at least not in markets. And then when I talk to an economist or someone who's looking at what's going on in the labor market, they say, we're concerned, we're concerned, we're concerned. Where's the difference here? Where does the gap get bridged?
Well, I think it's how you deal with uncertainty. So you mentioned earlier, our markets are looking to earnings, not the economy. I think it's because we have very little visibility on the economy. So what do you do when you don't have full information? Well, economists like to worry about the risks to one side or the other, but if you're trading, if you're taking a market position, then that tells you there's no big bets to be made in play. So it's the same state of play. It's not, in my opinion, that everyone is reading the information differently. It's what your job is and how to react to it and what your position in uncertainty really looks like.
And if it is a single stock based market, Mandy, just to finish here, is this a more stable market, one that's actually looking more at the fundamentals, or is it a meme stock craze market that's driven by what people are reading on Reddit?
So it's not meme stocks. I think where we're seeing the option activity, it's not pure speculative. But in terms of is this more constructive? Certainly, if it lasts, right? So the high dispersion, low correlation environment is dampening index volatility. It is one of the drivers of why the VIX is so low or has been so low this year, April notwithstanding. But as we saw with April, things can change very quickly. So what happened in April is we had a big catalyst, big shock. Markets repriced very quickly. We had significant increase in correlation levels, and that drove the VIX over 50. So as we head into next year, could that change? Could as the economy starts to weaken, if it weakens, I would expect higher baseline volatility, higher demand for hedges, and higher levels of correlation that could all really keep the VIX elevated.
Mandy Zhu, great to see you. Thank you so much for being here. Mandy Zhu of CBOE Global Markets. Thank you. And of course, Francis Donald will be staying with us through the hour. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahaira on it. Yahaira.
Hi, Lisa. The manhunt for the shooter who killed 2 students at Brown University is entering its 4th day. Rhode Island Governor Daniel McKee and other officials have said there's no clear security camera footage from the building where the shooting took place, which has hampered the search. The FBI is offering a $50,000 reward for information that leads to an arrest and conviction. Meanwhile, the European Union will effectively end an upcoming ban on combustion engines. Sources telling us here at Bloomberg, the European Commission will lower requirements that would stop sales of new gasoline and diesel-fueled cars in 2035. The new rules will allow for plug-in hybrids and electric vehicles with fuel-powered range extenders. And PayPal has applied to become a bank in the U.S. The payments firm is looking to take advantage of the Trump administration's openness to fintech companies entering the banking system. The company says if approved, the PayPal bank would help strengthen its small business lending capabilities. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahaira. Up next, the morning calls, plus the latest ADP employment data set to cross in about 2.5 minutes. Michael Collins of PGIM Fixed Income with us to break down those numbers and preview the payrolls report on deck in about 18 minutes' time. From New York City, this is Bloomberg Surveillance.
There might just be some unusual amount of noise. There's going to be a lot of information. We're going to be watching that quite closely to gauge to what extent the hiring might actually be starting to pick up. There are a lot of different tailwinds that sort of support the economy, even though you have seen a bit of a backup in rates. So the more cyclical, interest rate sensitive parts of the economy might still struggle, housing in particular.
That was Stephanie Roth of Wolfe Research as we await a key slate of economic data after waiting for so long for that information. The expectation for non-farm payrolls is 50,000 on the headline number. People are expecting the unemployment rate to rise to 4.5%. Meanwhile, we are seeing in markets a little bit of softness, at least in the equity space, a little bit of a bid into bonds as the session grows older. Not exactly an incredibly dramatic morning. A little bit of dollar weakness, but crude very much front and focus with prices down to the lowest levels going back to May, down 1.7%. Francis Donald's here with us for the hour. And Francis, we've been talking about how it's really a muddled moment, given the fact that the data is something you can choose your own adventure with, and it seems hard to get a clear narrative on.
Yeah, I think we're really used to in the past several decades having a clear business cycle. We go through a recession, we go through a boom, we go back into a recession, but we're not operating in that type of economy anymore. This is a supply side driven, less interest rate sensitive type of economy that is going through a myriad of cross currents, from mass retirements to tariff shocks. So if you're looking for a clean read, you're not going to get one. You kind of have to work through lunch and realize that there's many sub themes. For investors, that's a good deal. It means that there are opportunities as well as risks in every headline number, but it means we probably can't put too much weight into anything, even an NFP, which of course will get a myriad of market reactions. But the data is going to tell us one story and the true economy is another one underneath the surface.
Yeah, and then another one is the corporate story. We do have some economic data. Before we get there, time now for the morning calls. First up, Bank of America upgrading UBS to buy, believing it is set to grow EPS at the fastest sequential pace of any bank. Those shares up by 2.5%. Next up, Morgan Stanley double upgrading Roku to overweight, predicting growth will accelerate in 2026, likely ahead of consensus. And finally, Mizuho raising its price target on Tesla to $530, seeing better investor sentiment on robo-taxis. Turning to the economy, as we were just saying, ADP just crossing with the latest number. And Bloomberg's Michael McKee here with the numbers. Mike, what do we see?
Well, perhaps the least anticipated number of the day, ADP's weekly job survey says that in the 4 weeks to November 29th, the economy added an average of 16,250 jobs. That's a significant increase over the 2,750 for the week before. But this is a new indicator, at least as far as releases, and it doesn't seem to have much of a track record in predicting anything. Of course, it's been mostly out since we haven't been getting government data. So it isn't clear that this is going to mean a whole lot, but that's the number for those of you who are tracking it.
Michael McKee, stick around for the other numbers that we get, including non-farm payrolls from November. But let's just stick with the labor market, especially ahead of that data. Michael Collins of PGIM Fixed Income joining us now. Mike, first of all, how do you handle this ADP weekly number? Do you just completely discount it, or is it something that increasingly you put into your dashboard?
No, it's great, Lisa, to have more concurrent data, more timely data, like the weekly jobless claims is something that, for 30 years I've always been analyzing. And yeah, you do maybe a 4-week moving average, but the more timely the data, the better. And obviously the market, there's been a dearth of timely data. So all the data is welcome. As you know, we and economists and the Fed kind of take the whole cacophony of data, put it together and try to come up with a direction for the economy, a direction for the labor market, a direction for inflation, right? And it just feels like the direction is very uncertain right now, even though, I kind of expect the labor market to show continued weakness, notwithstanding the ADP little pop we got this morning, and, inflation probably to continue to moderate a little bit, right? So those are generally good conditions for the Fed and for financial markets.
Well, Michael, given the noise surrounding the headline number today, talk to us. What are you focused on? Is it private payrolls? Is it average hourly earnings? Is it retail sales? What are you going to be really focused on here at 8:30?
Yes, yes, and yes, right? We have it's like a holiday parade of data, right? And the question is at the end, do you see Santa Claus or the Grinch? And, right now you have to look at all of it. The consumer is super important here. So all the retail sales data, and obviously, we have, hundreds of analysts who are parsing all the actual underlying bottom up retailer reports every day. And, you're continuing to see actually probably an acceleration in this K-shaped economic behavior, right? Where the wealth effect is driving half of GDP right now. The other half of GDP, for what it's worth, is driven by, tech and AI related CapEx. So the U.S. economy is basically running on a pretty fragile two-legged stool, right? So those are really important factors that we're trying to assess and looking for cracks in. The weaker sectors of the consumer are really showing continued signs of weakness. So that's really important. The jobs data is really important because it's a reflection of the broad base of consumer demand. And it looks like, based on anecdotal evidence, you're seeing, layoffs announced every day by big companies and all this data that we're getting. It just looks like the labor market, job growth is going toward zero.
Michael, it seems everyone and their grandmother is calling for the U.S. Treasury curve to steepen in the year ahead. I'm just curious, a steeper yield curve, what does that mean for foreign investment? Do you think foreign investors are going to find value in the U.S. yield curve if it steepens or continues to steepen at the current pace?
Yeah, I always push back on this narrative that the yield curve is going to, steepen on its ear, right? That the front end will come down. And it has come down, right? The Fed has cut almost 200 basis points already. So you've had a pretty big steepening in the yield curve. 230s is actually very steep right now. But a lot of people think, the Fed's going to keep cutting, especially if you get a newly, more dovish Fed FOMC committee. The front end maybe goes down. Instead of stopping at 3, it goes to 2.5. And that hurts the back end. That causes the back end to go up. And I push back on that for the reason you just stated. When the curve is that steep, now this is a little, inside the yield book baseball kind of stuff, but the roll down you get, the returns you get by owning those longer duration bonds as they turn into lower yielding bonds, they actually have capital appreciation. And those expected forward-looking returns become so big and powerful, and the bond market becomes a tailwind when you have a steep yield curve, it will bring in buyers, right? And we've already seen the last handful of auctions we've had have actually been, solid, if not outright strong, right? I mean, we still have some of the highest yields in the world in the U.S. relative to, China and Japan and Germany, or, their yields are half or less than half of ours, right? And those are the big bond markets in the world. So yes, it will bring in foreign buyers. It will bring in U.S. buyers. It will cause U.S. investors to add duration, to add interest rate risk, to go from a 1 and 2 duration bond portfolio, which is where a lot of high net worth and retail investors are kind of hunkered down right now, to extend on the yield curve. So I think the narrative that the back end of the curve is going to get killed and kind of flail around is really misguided.
And a lot of this also has to do with inflation and what we see there. And Francis, I'd love to bring you in here. We just saw from this ADP data that inflation did come in, that wages, bonuses, and benefits rose 0.8%. That's down from 0.9%. You're seeing this sort of very gradual disinflation and not a lot of wage pressure. How much does that fortify what we just heard there from Mike Collins, this idea that you can get a bid into bonds, that some of the concerns about price stability have been overplayed?
Well, inflation is going to be another one of these indicators that is neither here nor there. We see inflation floating around that 3% level. Now, is that going to be okay for the Fed? Well, they allowed sub 2% inflation on average for the decade before the pandemic. Maybe they'll be okay with slightly above. As we talked about earlier, it'll depend where that inflation is. But there's probably a floor under how weak wages can go here, because it's our view that America primarily needs workers, not jobs, that they're going to come up against labor shortages more than an excess of labor demand. And in our view, that's going to keep a lid under how far services inflation can fall. And of course, we still have tariff inflation coming through from goods. That will be a Q1 story. So again, lots of cross currents in the inflation story, but where is it will matter most.
Mike, just quickly here before we get that non-farm payrolls report, what do you think the asymmetry right now is in markets, for a better than expected number or a worse than expected number?
We're certainly bracing and we're positioned for a worse than expected by being a little long duration and being very defensive in the credit exposure that we have, right? The markets, I don't know. I mean, the markets are really good at being two-sided here. I think if you got, an upside number, the front end would sell off potentially. But, you have a lot of, dovish aspects to the front end as well that are on the come. I mean, next 3 to 6 months, we expect interest rate volatility to increase, right? Because of the uncertainty of the FOMC composition, et cetera, and a lot of new fresh data coming out. But, I mean, it'd be hard to see the market move a real lot either way unless it's a gigantically outsized number.
Michael Collins of PGIM Fixed Income, Francis Donald of RBC, both of you are sticking with us. And Damien, the idea of bond market volatility or interest rate volatility picking up from the floor, because ultimately there hasn't been that much so far this year.
Well, here's with Michael. I will say this, and I'll challenge him a little bit on 30-year buying and moving out and along the curve. This isn't just a U.S.-specific phenomenon. We're seeing 10s, 30s steepening across the whole of DM fixed income, right? So, steeper curves, moving out along the curve. Good luck for investors, right?
Yeah, how much is this a Japan story as much as it is a United States one?
Exactly
Coming
right.
up, we are about 4 minutes away from that key payrolls data set. We will get you the numbers on the other side. Right now, markets holding their breath, waiting for this key number. This is Bloomberg Surveillance. "25 seconds away from the data release that we have been waiting for more than a week. Right now, this is how the stage is set. A little bit of softness heading into this non-farm payrolls print, led by the NASDAQ. Futures lower by 0.2%, 2s, 10s, and 30s. A little bit of a motley picture in the bond space. On the front end, just slightly up. On the long end, yields bid, maybe because of Michael Collins with that 30-year yield down 2 basis points. Right now, heading over to Michael McKee. It is that moment for the data. Mike, what do you see?
Well, hang in with me, gang, because this is going to be very complicated. We get an unemployment rate for November of 4.6%. That's 2 ticks higher than it was in September, 4.4%, and it's higher than the 4.5% that we anticipated. Change in there's no October unemployment rate, of course. 64,000 is the change in non-farm payrolls for the month of November. In November, the unemployment rate, 4.6%. Let me run through this a little bit here. What we want to find out is what happened in October. Loss of 162,000 jobs. Can that be right? In October. They're looking at a lot of federal jobs that went away. Maybe that's the 162,000. Let me just run through a couple other things here, and then I'll check all of these numbers. Change in private payrolls November, 69,000 positive. Manufacturing payrolls down by 5,000. Average hourly earnings less than anticipated, up just 0.1% in November. 3.5% for year over year, and 34.3% for average weekly hours. I'm going to do a dumpster dive in a dumpster that's on fire, and I'll find out more for you and be back in just a second.
Please do that, Mike. So we'll hold tight on that. If you want to take a look at the response in markets, it is absolutely a green flag to a Fed rate cut in the near term. You do see across the board yields lower, particularly on the front end. What that means for stocks is higher. Right now, take a look at that bid into the 2-year yield, down almost 5 basis points after being slightly higher ahead of this release. You are seeing a little bit of pushback. Damien, you've taken a second to look through these numbers. The unemployment rate rising to 4.6% really got my attention, but a host of things that could lead to a more dovish response from the Federal Reserve.
I think that's what the markets are focused on, that unemployment rate. You know, that tick up is bad news for the economy, is good news for the market. But I mean, look at private payrolls. I mean, you know, that was a number that a lot of people wanted to focus on, given, you know, the noise surrounding the headline figure with government, government employees coming off the grid. I mean, that was really, really strong too. So, you know, there's some good and bad. It just, again, to Francis's point, it depends on how you want to read the tea leaves here.
Well, Francis is still with us. So Francis Donald of RBC, how are you reading the tea leaves?
Slowly, because there's a lot of tea leaves here. But a couple things that jump out to me right away is the 3-month moving average now for non-farm payrolls is about 22,000. So if your break-even rate is maybe 30 to 40,000, then that means you're not creating enough jobs, and that's enough to lift that unemployment rate higher. But let's just remember, if you make a chart of the unemployment rate going back to the 1970s, there are only 2 periods in history where the unemployment rate has been this low. This is still a very tight labor market. So in my mind, I'm wondering why we're not using words like normalizing as we see that unemployment rate move back towards levels that we're more accustomed to. But while everybody's talking about jobs, I'm looking at the retail sales number, which is very strong. And so the biggest question for an economist right now is not what is the direction of the labor market, because that's sort of fuzzy. It's what are the implications of a weaker job market for the economy. And if the job market is weakening for young folks, 20 to 24, which is what we've seen in the past, if it is less hiring and not so much firing or layoffs, then the implications for spending are less. And so my first read on this is that, yes, we have what we expected, ongoing softness in the labor market, but it isn't creating a pullback in the broad economy. And that's going to be a really key narrative moving into 2026.
Which is the reason why people are bidding up equities and risk assets, even with potentially a worse than expected number. Michael Collins of PGIM Fixed Income still with us. Mike, just congratulations. You were positioned correctly ahead of this. I'm just wondering whether this was the read you were looking for, if this is just bad enough to keep the Fed in play, but good enough, to the point that Francis was making, to keep risk assets potentially attractive.
Yeah, we haven't heard the Goldilocks economy phrase lately, but, as Francis said, this is actually not bad, right? An unemployment rate, ticking up slowly, job growth close to zero. She throws out that, 30 to 40,000 numbers, kind of the new normal, right? So don't be shocked by these really low job gains. I think they're just kind of standard, given the population growth is really trending down in terms of immigration and births and deaths. I mean, fertility rates in this country have plummeted. And so this is the natural state, right? And it's not bad. It keeps the Fed in play. It keeps rates coming down a little bit. This is what we call the muddle through environment. And we have like a 50% base case probability on this muddle through, which is, growth slow but okay, inflation a little sticky, but not going up anymore, maybe even coming down a little bit. The Fed cutting rates a couple more times, rates staying in a nice range here. And corporate earnings have been really the star here. Corporations, the private sector has been the star, right? And they continue to figure out how to keep their margins up, which has really been surprisingly impressive to me.
Hold on one second. Michael and Francis, we'll get back to you 1 second. Michael McKee has some more information after diving into the dumpster fire. Mike, what do you see?
Well, it looks like October was a really terrible month. 105,000 jobs total lost. And that 162,000 I mentioned was the total loss of government jobs in the month of October. We also lost jobs in construction, about 1,000, and in manufacturing, 9,000 in the month of October. Just about everybody lost jobs somewhere during the month. Leisure and hospitality is a bit of a surprise because we lost about 9,000 jobs there in November, and that was lost 12,000 rather, and that was expected to be a sign of strength. Retail hiring, as Francis had pointed out, it's up. It's not extremely strong, but of course you've got seasonals working into this situation as well. But you got a 12,000 roughly gain there, 6,000 gain for the retail trade during the month of November. Speaking of retail, did not mention these numbers earlier. Retail sales for the month of October come in flat. The 0.2 gain in the month of September revised down to 0.1. And the retail sales control group, much better than anticipated, comes in up 0.8 after a negative 0.1 in September. So in October, people were still spending, got a rebound there, even though we lost a lot of jobs in the month of October, and it looks like there's a bit of a rebound in November. Not huge, but we are seeing a little more strength than we had.
Michael McKee, thank you so much. Damien, we do see the move in the markets kind of temper itself as people look at the details. Look at the fact that the response rate wasn't great, and look at the fact that there's a lot of strength despite some of the weakness that we see in the unemployment rate.
And in August and September, we saw revised down by another 33,000 as well. I mean, I'm just looking at the unemployment rate ticking up to 4.6%. You know, the labor force participation rate also ticked up, so that could be fueling a little bit of that as well, which is, you know, means it's not as bad as you would have otherwise thought. But yeah, I mean, you had some backward revisions, 33,000 jobs lost in August and September. That's just, you know, feeding the bullish bond trade here.
Mike, how much do you look at this data, given the fact that we have gotten response rates come down significantly? How much do you look at this data as truly better quality than some of the other data points that we've been getting versus just as noisy, just as easy to discount?
Well, there's a lot more of it, right? We have months worth of data now trickling out, and I don't know if the quality of any of it is that great, Lisa, right? So I think you have to take all of it with a grain of salt, which probably explains the market reaction. You know, you always see a big knee-jerk move when the numbers first come out, and then they kind of settle in and many times actually reverse, right? So, you know, the Fed doesn't meet for almost 6 weeks, so they have a lot more data to come, and presumably the data they get over the next 6 weeks will be higher quality and, again, continue to paint a bigger picture of the direction of the labor market, direction of consumption, direction of inflation. So there's a lot more to come before the Fed meets. And, you know, right now, as you know, the markets are pricing in basically the next cut, not really until June, and a second one by December. So really 2 next year, but really slowly throughout the year. And that makes sense to us, unless you get a big change in the direction of this data.
Michael, we mentioned this prior to the release. Manufacturing payrolls, they're now at their lowest level since March of 2022. Certainly not what the Trump administration would like to see. Talk to us a little bit about, you know, your read from there.
Yeah, I mean, this whole manufacturing, you know, renaissance that the administration is trying to engineer is pushing on a string to some extent, right? There's been lots of evidence and research done on the amount of manufacturing jobs and the desire for Americans to work in those manufacturing jobs, and the availability and education and skill level for Americans to work in those manufacturing jobs, right, does not bode well for this big jump in manufacturing employment. You know, we are a service economy, we're a technology economy, we're a financial services economy. That's where, you know, the jobs are. Those are the sectors that are doing the best, not surprisingly. So, yeah, I think you really have to, you know, push back on that, the idea that we're going to have this giant manufacturing, you know, labor market renaissance in this country.
So, Francis, I mean, equities are higher on this news, yields are down. What do you think the market's focused on right here?
Well, I'm focused on the fact that you called it. The big jump in the unemployment rate is coming from re-entrance into the labor market. And this is the big thing. We all want this number to give us a signal, up or down, but it's really the composition that matters. So what we do is we think about who is losing their job and who is actually being hired. And if people are falling into unemployment because they've started to look for a job and they haven't quite found one, they don't represent a permanent loss of income. They're actually starting the process again. So this is kind of bullish in the sense that it's enough for the Fed, if they want to keep cutting, this is a green light for them, but it isn't enough to signal that there's a hockey-shaped weakness in the labor market. It is enough to signal that growth is going to materially slow down or there's any sort of nefarious economic activity under the surface. And what have we learned from the Fed? They have a range of opinions. If they want to cut, this is the data that allows them to do that. If you want to maintain a hawkish bias, there's enough under here to tell you, hey, the economy's fine, retail sales are up, the control group did really, really well, and there's still a lot of uncertainty around how much we should read into these numbers.
Right now, the market is just pricing in a slightly higher chance of a January Fed rate cut. Michael McKee has a final thought. Mike, what do you see?
Well, a couple of notes from the BLS. They're saying they cannot quantify the impact of the government shutdown in October and November in the data. They do have a household response rate, which is the unemployment rate survey for November, that's lower than usual, just 64%. They had a tough time getting a hold of people, and it took them an extra couple of days to do that data, and they still didn't get enough. But the payroll survey collection rate was higher than usual, so the numbers may be a little bit more trustworthy. We can note, in terms of the unemployment rate, it's an unrounded 4.564%. September was 4.444, so it was more than a percentage point increase in not a percentage point, but a 100 basis point, move higher. Excuse me. A lot going on here. And then the other thing I would point out is that we don't have any data from the household survey in terms of hiring and firing, but we can do the math. And from September to November, we added 323,000 people to the labor force. We don't know what happened to the labor force in October, but over the 2-month period, we've increased the labor force. So as Francis was talking about, if people are coming into the labor force, that may have had an impact on the unemployment rate. So where we are right now is waiting probably for the December numbers in January to get a really good sense of how the economy is performing. But job side of the mandate, not so great. Retail sales looks like it's okay.
Michael McKee, thank you so much for this morning. Mike Collins of PGIM Fixed Income, just quickly here, how much do you think this really does greenlight the potential for a rate cut, given the fact that the unemployment rate might give the ammunition that this Federal Reserve is looking for?
Yeah, I really think the Fed should pause here, take a breather, get another handful of months of data before they move again. Like I said, they've moved almost 200 basis points already. As Powell says, they're kind of getting toward the neutral or in the neutral range right now. The lack of consistency and consensus among the FOMC members is really remarkable. How you have a bunch of people who actually think they should hike rates from here, a bunch think they should keep rates the same, and a few think they should cut once, twice. I mean, it is a real scatter plot of views among the committee. So it feels like the general tendency is to just pause and wait. Like I said, the markets aren't pricing in a full cut until June, and that seems like the right path for the Fed at this point, unless things change dramatically between now and then.
Michael Collins of PGIM Fixed Income, thank you so much. It seems like markets have retraced a lot of where they were from before this release. Do you agree with that, Francis, that even though there's a lot of division, it seems like this is a Fed that may cut but probably shouldn't?
Well, it's jobs day, so it's the doves day. They get to focus on their side of the mandate. But in 2 days, 48 hours, you're going to be doing inflation day. And if consensus is right and CPI jumps to 3.1%, well, that'll be 56 months that inflation is above the 2% target, going in the wrong direction, and everybody and their mother knows that there's goods inflation still coming in the system. So on Thursday, it's going to be really easy for the hawks to argue their side of the mandate. And this is the problem when you have a dual mandate. You're in a stagflationary light type of environment. You have a Fed that is revealing its bias towards the employment side, but it will be easy to make the case that inflation is still problematic at the end of this week. So balancing those two will be important. Fed speak will be important going forward, but I'll continue to emphasize the details matter. 4.6% that is driven driven by new entrants that has a lot of healthcare jobs, sticky healthcare jobs in it. That's a better type of weaker job number. Inflation that is broad-based or has services component inflation in it on Thursday will work on the other side. So let the doves have their day, but Thursdays, I think, will belong to the hawks.
And you can feel that tension in the yield curve, the 230s gap getting to the highest level going back to 2021. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. Recapping the payrolls data we just got, the economy adding 64,000 jobs in November and the unemployment rate rising to the highest since 2021. October jobs data also coming out showing a decline of 105,000 jobs, the largest drop since the end of 2020. Meanwhile, Rob Reiner's son has been arrested for allegedly killing his parents in their Los Angeles home. 32-year-old Nick Reiner is being held without bail. The case will be presented to the Los Angeles County District Attorney for filing consideration today. Celebrities and politicians took to social media to mourn the star who directed classics, including The Princess Bride and This Is Spinal Tap. And OpenAI's deal to license characters from Disney for its Sora video app is entirely in stock warrants rather than a cash licensing fee. That's according to people familiar. Last week, Disney announced it would let OpenAI pull from its library of more than 200 characters while agreeing to take a $1 billion stake in the company. That's your Bloomberg Brief, Lisa.
Thank you so much, Yahaira. And Yahaira will be back with us in just a moment for your movers. Up next, Jeff Rosenberg of BlackRock breaking down the latest data. This is Bloomberg Surveillance. The initial read isn't always the right read. Initially, there was this pop in bond price yields lower. There was a pop in stock futures. We have reversed that down 0.1% now on the S&P. We now see yields marginally higher for the 10-year, back up to 4.17, and marginally just a touch of dollar weakness. Under 1 hour away from the cash open, here are your morning movers with Yahaira Anand. Yahaira.
Hi, Lisa. A lot of sell-side action to get through, and we start with Roku. Those shares are up nearly 5% in the pre-market after Morgan Stanley double upgraded the stock to overweight with a price target of $135. And the call is all about advertising, with the bank saying that 2026 will be a strong year for ads in the U.S. and connected TV will stand to benefit the most. Meanwhile, moving on to Southwest, those shares are higher by 2% after Barclays raised its rating to overweight and set a $56 price target. The upgrade follows comments from the CEO just last week talking about Southwest pursuing airport lounges, something that we've also seen with JetBlue. And Lisa, I know you're talking to the JetBlue CEO later this morning. And we end on Estee Lauder shares. Those are rising 2% in the pre-market after Bank of America raised its price target to a street high of $130. And they're citing a pickup in demand in China and the U.S., which represent about 40% of Estee Lauder's revenues. Bank of America also naming Estee Lauder its top beauty pick in the booming beauty market in 2026. Lisa.
Thank you so much, Yahaira. Let's turn back to that payrolls report. Jeffrey Rosenberg of BlackRock joins us for some response. Jeff, do you think that this really changes the needle in any way?
Well, Lisa, you stole my opening line. I was going to do a little hat tip to our friend and colleague, Jonathan Ferro. He always says the first reaction is not always the right reaction, and you said it at the top of the hour, or there at the top of the segment. The headline was what the markets were reacting to, the little bit higher than expected unemployment rate. I think you guys in the earlier segment decomposed that pretty well. The labor force participation rate going up, so it's not that bad. I don't really think, to answer your question, I don't really think this really moves the needle. If we look at the November number, 64,000, pretty close to expectations. And let's not forget that we're going to have another payroll report before the January meeting that's going to make these other two much less important. So I don't think it really moves the dial a lot. And I think what you're going to see here, and we're already seeing in the market, is that retail sales control group number was pretty strong. And you look at the earnings part of this report, average hourly earnings, on a month over month, a little bit weaker than expected, but the yearly number, 3.5%, that's still pretty high. real incomes, and the wealth effect here supporting consumption. So that's really, I think, the bigger story here for the market move.
At this point, Jeff, if the Fed does cut rates, maybe not in January, but maybe in March, and you do get that fiscal impulse coming from the federal government, at what point is there a risk of some sort of increased sell-off at the long end, sort of the opposite of what Michael Collins was talking about?
Yeah, I mean, this is a little bit of a replay of what we saw happen last year when we had the Fed's cutting interest rates cycle. You look at last week and what was the market reaction, and it was a steepening in the yield curve. So there is a little bit of a message from the bond market here that, yeah, the Fed's going to control the short end, but the long end is reacting to better growth, sticky inflation, demand for capital that we're seeing everywhere that pushes up the term premium. And so I think that is more than a risk, Lisa. It's the reality of what we're seeing in the market right now.
Jeff, I take your point that average hourly earnings at 3.5% year over year is high, but it's still the slowest pace since May of 2021. And that leads us into CPI later this week, right? I mean, we're going to see some inflation data. What are you looking for there?
On the inflation data?
Yeah, CPI.
Yeah, and as the earlier commentator talked about, I love the framing. You know, today's the day for the doves, and inflation is the day for the hawks. And the pivot and the framing is correct. The inflation side is what's been the concern for the hawk side. I think the argument there is, yes, inflation is high and it's persistent, but it has been coming down. And I think the argument that the tariff-related components are really the drivers of that underlying inflation stickiness, and this is the key unknown, is tariff-related inflation a one-off, or is it an inflationary process? You've heard Powell talk about it. I think there's a pretty good consensus around the argument that tariff inflation should be a one-off rather than a process. And I think when you're looking for the process of inflation, look not to tariffs, but look back to what we were just talking about. It's really in wages and the stickiness of wages. But on the wage side, as you just pointed out, those two are also coming down. So, you know, there's a debate in terms of inflation. We're going to, have another data point.
I think we've lost Jeff Rosenberg of BlackRock. Thank you so much for that. Frances Donald, the queen of that way of describing things in terms of the days for the doves and the day for the hawks. Just what are your final thoughts? Your sort of read through of a motley slew of data that really paint a complicated and nuanced picture.
Well, if we put aside the path, we woke up this morning and I just said to you, Lisa, hey, there's a bunch of new people who joined the labor force. We still have wages that are running above inflation. There's half of jobs are coming to healthcare, which is what this economy really needs. And we have real wage growth underneath the surface. You probably wouldn't say, oh, the U.S. economy is collapsing and we're heading into a recession. And that's the story that we have today. Now, momentum matters. We do have a labor market that is slightly softening, but so does historical references. And as I said earlier, we still have one of the tightest labor markets that we've seen in 50, 60 years. Let's not get ahead of ourselves here.
Frances Donald, thank you so much for being with us this morning. Wonderful to get your thoughts. Coming up tomorrow, don't miss this. Stephen Auth of Federated Hermes, Veronica Clark of Citi, Republican Congressman French Hill, and Liz Thomas of SoFi. Damian Sassa are also back. Thank you so much for being with us.
Thank you for having me.
As always, this was Bloomberg Surveillance.